Ladies and gentlemen, welcome to the great and powerful SoFi Q2 2025 earnings on time. With me is the great and powerful Tevis. How are you, brother?
I'm good, man. I'm good.
And joined very rarely, but it's always a pleasure. Chris, data-driven investing.
Morning, everyone.
We have 4 minutes until earnings actually end up getting dropped. We will be refreshing like madmen on their website and in different sources where we might be able to pull the numbers up. We're hoping for good things. We all independently did our own predictions, so we're going to see who could potentially come closest. And then over the next hour between 7 and 8 a.m., we're going to try to break down the numbers. That's everything from individual segments to stock-based compensation, customer acquisition costs, and everything in between. So we'll have a little bit of time to do that. And then Noto should be talking at 8 o'clock through 9 for the actual earnings call. So we're here. This is it. Christmas came early.
That's right. The stock is up in the pre-market. I don't know why, but it's pumping for the last half hour.
It sold off for the last couple of days going into earnings, which was interesting, right? Because
it's a good sign.
Is that a good sign?
Yeah, I mean, I think it would be harder if it was $25 going into this earnings and then continue to ask for more.
Yeah, I'd rather have consolidated over the last several weeks rather than have a violent move kind of going into earnings. So
yeah,
we'll see.
Up 1.7% in the pre-hours.
Which doesn't mean anything until the numbers come out. So
correct. But maybe some people are excited. I mean, I don't have any shares
either way
for today, but
we'll try to be high energy, even though it's like 4:55 a.m. my time, as I guess I showed you my phone when I got here. So
yeah,
that is way worse. That is way worse.
Yeah, I was listening to you complain about getting it up at like 7 a.m. and I was like, dude. But the thing is that like SoFi headquarters are in San Francisco. It's 4 a.m. for Noto and team.
Yeah. I don't know why they don't do it after hours, but banks traditionally just don't. They do it before market opens.
Yeah, I preferred after hours personally, but
yeah. But okay, so earnings should be coming out in the next minute and a half or so. I will have X ready as well, just in case if someone gets the numbers on any Bloomberg terminals or anything like this before we see it on their website. And essentially, what's the analyst predictions right now? 804 million in revenue.
It was 5 cents of EPS.
5 or 6 cents, yeah.
6. No, it was 6. It was 6 last I checked. Let me see. I'm pulling it up.
Yeah. 6 cents of EPS, 804.4 million. So those are the numbers to beat.
Is that the official estimate? 804.4?
804.36 on fiscal.ai.
Yeah. And then so that'll be the target that we're looking to beat, but guys, like literally it's right now.
The EPS estimate was what? 5 cents? 6 cents? 6 cents.
6 cents.
Oh.
The EBITDA number 205.7.
Stock still up 1%. In the pre-market, and massive jumps up, start up 3% in the pre-market. Maybe some numbers are getting released here, guys.
Let's go.
Let's see.
I don't 2.7%.
I don't see anything on the news page.
I don't see anything in the news page, but we're seeing a lot of volume in the actual stock right now.
Yeah.
3.5%.
Well, it doesn't look like a giant miss on first. On the algos don't think it's a giant miss.
Yeah, but also the absolute original thing can be much different than what the numbers actually say. But I'm also positive. I don't see anyone.
858.27
Double
and
B.
8 cents.
858.27 and 8 cents.
Yep, that's crazy.
That is a big number.
These are monster beats, ladies and gentlemen. Let's go see how they actually did it. Monster beats.
There it is, Q2 2025.
8 cents of EPS was higher than every single one of our estimates.
Nah,
Okay,
I had 8 cents. Hold on, I had 8 cents.
Did you?
Yeah.
I thought we all had 7 cents.
All right, the presentation's on the website.
Oh, refreshing. Yes, it is. Okay, let's switch out of here.
I'm still looking. Still scrolling.
Okay, record adjusted net revenue of 858 million, up 44% year over year. An acceleration in the highest growth rate in over 2 years.
Oh my gosh.
Record adjusted EBITDA of 249 million, 29% margin. That's also higher than I thought. 97 million of GAAP net income, an 11% margin, higher than I expected. 7 straight quarters of profitability.
Financial services is 303 million. Roy wasn't bullish enough.
Wow.
Fee-based revenue represented 44% of adjusted net revenue. That's the highest we've ever seen. Financial services and tech platform contributed 472 million. So wait, what is that? What did you say financial services was?
303.
No, it was 303 last quarter.
Oh, no, sorry. 362.
362.
So then the tech platform got
my bad.
112, something like that.
110. 109.
Tangible book value
and lending
grew
was
1.1. What?
Or 447. Sorry. Lending was 447.
Tangible book value grew 1.1 billion year over year to 5.3 billion. Total deposits grew 2.3 billion. That's also good. Let's see here. Added a record 850,000 new members and 1.3 million new products. Guys, this is the most insane quarter. Oh my gosh, bro.
This is really good.
Increased origination and sale of loans outside of SoFi's credit box, monetizing more than 100 billion in unmet loan volume. The business is now running at an annualized pace of $9.5 billion of originations and $500 million of high margin fee-based revenue. This started a couple quarters ago. Oh my gosh. Okay. Yeah, we know all this. We're at 11.746 million, adding 846,000 new members.
Fee-based
LPB,
revenue.
here you go. LPB this quarter, $2.45 billion in originations.
Is that like 800 million higher than last time?
That's more than last year combined. Like that's more than Q3 and Q4 of last year combined. 2.45 billion.
It's seeming like the amount of new members that they're going to try to add on is 34% year over year. It's something like 7.6% quarter over quarter, and just continue to try to add that many. And like that's how we have to get to the 50 million, right? This is higher than I had the highest prediction for members, and this smashed that number. Guys, I don't think there's a metric that we suggested that it needed to be high. Okay, wait, let's just go to Outlook. I'm sorry, I got to ruin the fun here.
Well, let's look at guidance. I haven't seen the guidance slide yet.
Updated guidance. I mean, yeah, we already see it. In adjusted revenue went from 24 to 27% to 30% year over year. 3.375 billion. That's higher than like almost every single analyst, by the way. They'll have like 28% year over year, and we still have more quarters to adjust this higher. Net income went from 9% margins to 11% margins and up another $50 million. And EPS went from 27 to 28 cents to 31 cents. Analysts are going to have to change their updates because I think they're at 28 cents right now. Stock up 5% in the pre-market.
Dude, this is a really, really good. I'm sorry for your covered calls, Tevis. I'm so sorry.
It's fine, dude.
That's
It's like on a portion of that position, and they're like end of September anyway. So
listen to this though. Tech platform adjusted net revenue of low double-digit growth to teens. So they expect some level of acceleration this year.
This year, so it went from 95 to 110 year over year.
Financial services growth of 60 to 65%. Loan growth of single-digit billions. Member growth of at least 3 million, or approximately 30% from 2024 levels. Did that change? I thought it was 2.5 million, not 3 million. Member growth of at least 3 million.
Yeah, I think they raised that too.
yeah, and the tech platform growth, they also raised it to the double-digit range as well.
Dude, this is a really good quarter.
Dude, can you imagine if we guided for this? Like one of us came in with these predictions, we'd be like, "Are you crazy? Like, what are you doing?" And then they actually pull it out. Holy crap! Tech platform added 2 million quarter over quarter. So yeah, it does seem like there was still a lot of chime in there. If it's only 2 million, but that they are back to growth now.
But it also means that we're getting that there's some sort of Technisys deals, right? Because it's not all down to Galileo counts, and there was, $4 or $6 million of quarter over quarter revenue growth in the tech platform. I'm trying to see in the press release if they talked about any new deals.
PayPal's down 4%. And SoFi's up 6%, 6.6%. Should have been here, Roy.
Should have been here, Roy. What is everyone? Let's see. UNH was reporting this morning too, right? They're down another 4%.
So
UNH down 4%.
7%.
What is it? P&G? What is a PG? They're flat. 0.6.
Cow.
I mean, guys, I think we have a winner here, up 7.75%.
This might be they're like, this is the moment.
This is the greatest quarter I've ever shown off in SoFi's history. We need to look a little deeper to find if there is any misses here, but
I don't see anything, man.
Student loan net charge-offs took quite a large increase, nearly doubling this quarter, but in the same breath, personal loans had fallen off a cliff. So I'd rather have personal loan delinquencies fall than worry about student loans rising.
Personal loan originations were 6.97 billion in the quarter. They killed our estimates. Like, I expected 5.8. You were like 5.75, or the other way around. It was they originated over $1 billion more than you and I expected.
Dude, weren't there, like, whenever the first year that we started covering this company, like back in like 2021 area, didn't they do that in the year?
Yeah, that's probably about right. Home loans, I didn't expect. Home loans is at 800 million.
I had 770 or something.
Which it means a lot of cross sell.
Yeah.
Because that's where all of that volume comes from, is all just cross sell.
Personal loans, their loan sale execution, gain on sale margin, whatever, is 105.8%, which was higher than what they had the loans marked at as well. So that continues. I'm looking on their loan platform capability page, which still only has loan or personal loans in there. So I don't think we're going to see anything like student loans are now able to be sold, which is insane because whenever they do add those, the growth will just continue.
That's nuts.
Okay, so was the 50% comments, did that end up coming true? I guess it did, right? Because the financial
services was just killer. And then tech platform was stronger as well.
Yeah, tech platform was stronger too.
Oh my God, man.
858. That is such a high number.
858. Yeah, for new members.
No, for revenue.
Oh, sorry. Yeah, no, we're almost doing a million a new member here.
Dude, it's insane. Financial services is just wild and still expanding in the margins as well.
Bro.
Gosh. I haven't even looked at the comments. I'm too busy looking at this. I assume everyone else is as excited as we are.
Yeah, I haven't even
Holy
looked over. Best earnings results yet. I said wait for Anthony Noto to go in offense mode. I mean, it's true. He's only ever played defense. Like, let's just see what this company does whenever the macro's on their side. This is before rate cuts, ladies and gentlemen. This is like, I don't know. Very, very exciting.
Dude, 106% year over year on financial services.
That's nuts.
Yeah.
I mean, this is going to be the best quarter because it was the last second quarter. Like year over year, it's going to be the best because we're comparing when we didn't have the loan platform business. But
they're still expecting only 60 to 65% growth rates here. I don't believe that. I feel like they could definitely
15% growth on the tech platform, eh?
That's what we saw, 15.
Yeah.
Yeah. See, my year over year was guided for, I think, 7%. So, just double.
I don't see anything on the press release for like Galileo deals. So I wonder. The thing is that we could get some could get some stuff on the call. What? Sorry.
We're looking at revenue, and it blew away all of our expectations. Did you see what corporate revenue was?
Oh no, what was it?
61 million.
Negative.
Oh. That's
so
crazy. They clutched out a unbelievable quarter with a $61 million corporate revenue line.
I mean, it does reconcile in the end, right?
Dude,
so it's possible that anyway, we'll get into that.
Both Chris and I had to ask negative for corporate revenue just means how high the total revenue number was.
Well, yeah, it had to be negative, right?
Well, it's been positive before, but if it was, that would have been less fun. Lending.
Josh's calls, if Josh is watching, his calls are printing right now because I think he wrote short-term calls over earnings, which is crazy.
Well, congratulations. That's freaking amazing. I want to start plugging some numbers then.
Oh my gosh.
Yeah, this is incredible, ladies and gentlemen. To the new people that are coming in and wondering if this is a great quarter, this is by far the best quarter we've ever seen from SoFi. It blew away every single one of our expectations in every category. Tech platform destroyed our estimates. Roy on financial services was not bullish enough. New members at 840,000. Forget it. Try 856. What was it? 846? 846. This is ridiculous.
Yeah. Somebody said best bank in the world. It's like, yeah, I mean, like they're growing like 43% year over year. So it's definitely a fast growing bank if you want to categorize it like that. Sure. I won't complain.
Oh my gosh.
Wow.
Hard to look at a company and project out its linear growth if it's not going to stay linear.
How much do you guys want to bet that they drop a PR in the next couple of hours on something?
I mean, we'll see. I don't
got that.
We'll see. But where did all the loan platform business, that's an extra 700 million in LPB volume that wasn't announced?
Yeah, but that's just smaller deals, right?
It could just be smaller deals, or they might have just held something back.
Every quarter that I've seen them, they've done about 50% of their volume was done from deals that were not announced in the loan platform business.
Holy cow, man. This is after the recent run up. This is such a good quarter to justify it.
17.1 million products. Holy. Okay, let me bring up what I'm reading. By the way, I'm reading the press release, which always, guys, if you're into SoFi, you got to read both. They put different details in both of them. But seriously, we've accelerated adjusted net revenue growth to 44% year over year, the highest level in 2 years, driven by record high new members as well as new products. But remember, new members, as Chris always says, is the greatest indicator of future growth. Those customers, whenever they first get on the platform, they first start depositing money into their account, tapping their debit cards, is whenever they're going to contribute to the revenue lines the least. Okay. As time goes on, they actually start to build up a deposit base, start to spend that, invest it, everything. So, what you always see across many of the financial services businesses, like whether you're looking at New or Block, is that the longer the time someone is on a platform, the more they contribute to their overall revenue and profitability. So these 850 or 46,000 new members that just came on will all be massive compounders of their own, quality as quarters go on. So the faster we can get up new members, the faster we can get up revenue over time. So this is a great sign for future quarters. I don't know if you guys have anything to add to that, or if you disagree.
No, I completely agree. The LPB brought in $130.6 million in this quarter. So the LPB is now on a run rate of like over $500 million, and it's less than it hasn't even been a full year. I guess it's been exactly 1 year.
Yeah.
And it's on a run rate of $520 million in fee-based, zero risk revenue,
which is insane, right? The goal for like a company like Robinhood is to add on, $100 million segment, and there's a lot of new segments that they've added. But then you add on one for SoFi that does 500 million. It's like, doing 5 of what Robinhood,
it's 5 of their products
as well. Sorry, just going through some of this. The total fee-based revenue reached a record of $377.5 million, up 72% from the prior year. The reason why this is so important is that one of the bear cases for SoFi is that it doesn't deserve a premium because it's a bank, meaning that some of its revenue lines are at risk of not only being lost, but actually turning negative and going against SoFi, because loans can go delinquent. People can throw their keys on the table and say, okay, SoFi, come get the house because I'm done. But if we end up getting fee-based revenue, like what they say here, origination fees, referral fees, interchange revenue, which is the tapping of your cards, or brokerage fees like payment for order flow, that there's no way to turn that revenue back around on SoFi. That's pure revenue that just goes directly into their pockets. So the more that we can grow this side of their business, the higher the multiple that you can give to SoFi. The amount of fee-based revenue that we just saw, 44%, was the highest they've ever seen. So this does point to SoFi needing a larger multiple. Loan originations reached record highs with expanded product innovation. SoFi originated a record $8.8 billion in loans during the quarter. That's insane. That was our yearly before. With enhanced technology and improved fulfillment capabilities, SoFi launched a new personal loan product for prime credit card customers. Personal loan originations were up 66% year over year. Student loan originations were up 35% from a year ago with a new flexible student loan refinancing option. And with stronger technology, improved fulfillment capabilities, and a recent home equity offering, SoFi's home originations increased by 92% year over year. Watch out, Rocket Mortgage. SoFi's in town.
It's a long way to go before we get to Rocket and UWMC volumes.
Anything to add on what we're seeing here, Tevis?
I'm just astounded by the numbers in the loan platform business. The fact that it's so in its infancy and it's adding these numbers to the top line is staggering. It's like it just breathed new life into this business. Not that it was like, a stagnating business by any stretch of the imagination, but the growth rates that we have right now are not comparable to the growth rates that we had, 1 or 2 years ago.
Yeah, they also said that they hit an all-time high in unaided brand awareness of 8.5%. But this is always a tricky number for me. I always feel like they say it's 7%, then they'll say it's 11%. Like I never know how to gauge that, because to me that's not an all-time high.
Mhm.
But
Yeah, they've said stuff. I guess it depends on, maybe they had like a different assumption for how it was. I don't know.
yeah,
Yeah,
different
I agree with you
provider,
on that one.
different time of year. Like I'm sure they have their reasons to justify that is at a new high.
And net charge-offs and delinquencies just continue to drop. Now, part of that is because they're originating so many new loans. New loans don't right? They don't charge off at the same rate as old ones. So the fact that they've got so many new loans on their book means that that number was probably going to come down anyway, but it's dropped a lot. Like,
Ladies and gentlemen, the stock is up 6.9% right now. PayPal's down 3.5%. UNH is down 3.8%. I can see who else is reported. Maybe we can get some quick numbers on SoFi. And also, I think Anthony Noto has just tweeted. I think I just saw his name.
yeah,
Yeah, SoFi's Q2 2025 results crushed the rule of 40 at 73%.
It's a bank.
Mm.
Yeah, 44% revenue growth, 29% EBITDA margin, and then he also shouts out Kyle the stock goat for his analysis.
Does he actually?
Yep. He retweeted his tweet on the rule of 40. What do you think that was a joke that I was just doing?
Yeah, I did.
PayPal really quickly. Looks like they also beat on EPS and revenue. Revenue was up 5% year over year. EPS was up 18% year over year. They got $1.40 versus the $1.30 expected, and essentially another $200 million in net revenue that no one was expecting, which is a nice add. You need to go in there a little deeper to find out what was, the great assumptions, but that people might think that is missing on the quarter. Overall, I'm happy that what was that whole thing that we sort of drew our carriage to the wrong horse? Well, fresh horses, baby. Okay.
Hitched our wagon to the wrong horse. Is that?
Yeah.
There you go.
I have no excuse because over there it's like 4:23 or 5:23 or something. What time is it right now for you?
Yeah, 5:23.
Yeah. Okay. I think if someone can go through these numbers, I can start plugging these to see how different of like the credit card numbers there already. Like some of these look like high numbers, but I'd like to see what it is quarter over quarter.
Here.
If someone can share their screen.
Chris just dropped, so I guess it's on me.
Here, let me go ahead and click. Okay, share your screen, Tevis.
I was trying to buy time for Chris to join back so he can share his, so I can keep tweeting. But I'll share mine. It's fine. I'll take one for the team, guys. All right.
Okay.
Where do you want to start, Chris?
So here, if we go real quick, let's share. So Stock Market Nerd does his Brad does his
one
thing,
pagers.
His one pager. So we can pull this up.
Are you sharing anything? Yeah.
Yeah. So that's a lot of green, right? Like they beat on revenue, they beat their guidance, they beat their member estimate, they beat EBITDA, they beat on EPS, so they raised the annual guide by 3%. EBITDA guide by almost 10%, right? And like, man, this is such a good quarter. I can't get over how great this quarter is. Like everything's so good. My gosh. Sorry. All right. Here we can go back. I'll stop sharing now.
You can throw my screen back up, and then if you want to walk through something, I'm just looking at the highlights here, and we can jump to whatever part. I was mainly looking at the financial services this whole time and just posting about that. Like that's the piece that's most interesting to me. Um, just because it's dragging up everything else. I mean, everything's growing, but financial services growth is just dragging everything else up so much more, you know.
And I
It's
think sorry, go ahead.
No, I was just gonna say I can't stop looking at the member count. Like, I really thought I was like, okay, 850 or 810 to 850,000. I was like, man, these are some high numbers. Like, I even kind of feel a little weird putting it this high because that's a hard comp, but then they just blow it away.
Mm-hmm.
The interchange fee revenue is also up 83% year over year. And that's a pretty good indicator for people actually using the products as well. So that, like, that's up 83%, even though members
So
is only
true.
up 34%, right? So that means a lot of those members are using SoFi debit cards and SoFi credit cards for their everyday payments and switching over, and more of them are using it as their individual, like their first bank, their primary bank. That's the word I'm looking for. It's 5 a.m. Sorry, my words aren't coming out quite as good as usual. But man,
That's a really good highlight too. Credit cards, like, or you are 100% correct that the amount. Holy, you want to talk about how much people are using the platform? By far the largest amount of new credit card ads at 38,000 this quarter.
so they must
38,000, the
be.
last highest. And remember, there was a massive hiatus for credit cards. Last highest was last quarter at 26,000. The last highest before that was Q4 of 2021. So credit cards are ramping.
That's their next growth vector. Well,
Yeah,
one
they
of the
said
next ones.
there's an old quote from Anthony Noto that I showed off in my video recently where they said they have or they had one credit card product and they want to have 4 in their suite of products. Currently, they have 3 now, and they've leaked that they are looking at getting a 4th card that could, accelerate growth there. The Invest product has not seen growth since this level of growth since Q1 of 2022, 169,000 new members. Let's see if we can just shatter records across the board here.
Guidance 31 cents of EPS. Just
SoFi
doubled.
Money, 410,000 new accounts. That's the highest in the last 3 quarters, which is nice.
Just enter your numbers and then you can share your screen on all the additions.
Okay. Will do.
Yeah, it's just crazy how much of this business is not interest income, like the fee-based revenue through the loan platform business.
44%.
Yeah, it just came out of nowhere, right? Like look at the second quarter of 2024, like literally last year, 37, million compared to 139. And then just right now, just
Yeah, unreal.
and it's gonna be like if you give it one more year, it's gonna be like 70% of total revenue at this point by this time next year. It's wild. It's completely taken over.
Bro, the home loan growth. Oh my gosh.
No,
We have not
it
seen
looks
this growth since ever. And
The-
by a long shot. This was the most amount of home loan products, which also has to do with HELOCs and different products that we've added as well. But yeah, just crazy.
the flywheel is actually like you can see the flywheel starting to take off because
Yeah.
Invest is growing, credit cards are starting to grow, like home loans, like it's all these smaller things that are indicative of people bringing more and more onto the platform. Because it used to be, right? It was that lending was kind of driving everything and personal loans were driving everything, right?
Yeah.
Personal loans is still driving a lot, don't get me wrong. And like especially through the loan platform business. But at the same time, like the uptick in cross sell, we'll have to look at the individual. I mean, I haven't calculated how much like what the products per member are right now, but all of these ancillary products, right? The credit cards, the invest product, the the home loans, like you were saying, like people are starting to use their other services and the interchange revenue going up 88% year over year or whatever it was. It's all indicative of the fact that they really are building an ecosystem and people are starting to engage with the entire ecosystem rather than just a single part of it.
It is absolutely incredible.
I love the way that they're visualizing this now, where you can actually see quarter over quarter relative to year over year. And then on top of that, you can see loan platform business originations here.
Yeah.
Because then, like in future quarters, what you're going to see, which we didn't see in this quarter, is you're going to see these gray boxes be in student loans, home loans, possibly because all for the loan platform business.
Yeah.
I mean, here you had more originations in the second quarter for loan platform business than you had all of 2024.
I think, well, let me see. What were Upstart's originations last quarter?
Am I reading that right, guys?
What?
You had more originations in the loan platform business in Q2 than you had all of 2024?
Yeah,
but
it was only 2 quarters, but even still, yes.
Loan platform business started in Q3 and Q4. That's it.
Right.
But yeah.
Even still. Yeah, so in Q1 of 2025, Upstart's business was 2.1 billion in loan originations. So this is like, I mean, they'll probably increase in Q2, but it's probably going to be close. Like the loan platform business in a year is doing probably close to the same amount of volume as Upstart's entire business.
You guys want to know something crazy? Prepayment rates on personal loans went down. Average coupon rate went up. Default rate went down.
The coupon went up?
Coupon went up.
Huh, that's surprising.
5 basis points. 13.12 to 13.17. Quarter over quarter, I mean. Default went down and prepayment went down. Like, find me the bad part.
Yeah,
I
I'm
wanna
still
see-
looking for it.
I'm looking for where we stumbled at all. Just incredible.
The gap between like the vintage curves that they show, the gap between their 2017 vintages and the current vintages widened even further.
Yeah, it's so
Like,
good.
Is it
This-
above
Yeah, it's right
10%
there.
now?
well, no. I'm saying like like, I mean, it looks like they're trending towards around 6% life of loan losses, and they
they mentioned
want to be below 7 to 8%.
They mentioned here, in order to surpass 8% life of loan losses on all Q1 2020 to 2025 originations, the remaining 40% of unpaid principal would have to experience a near 10% loss rate.
Isn't going to happen.
Payush, thank you for the donation. SoFi posts a blockbuster quarter. Why its CEO says things can only get better. Community fund SoFi. Absolutely, Payush. I'll do that. I'll buy $10 worth of SoFi with the donation.
Anthony Otto casually reposting Army football like just 30 minutes before the call. He's just watching, just reposting on Twitter. I love it.
That's some Elon Musk type activity.
Yeah. I mean, at least he's not full Elon to do it during the call, but yeah.
Just scrolling memes. Yeah. I'm trying to find where they actually posted just like straight like the member count, but I can't seem to find it.
It's not in the write-up.
Oh, I'm sure it is, but
what are you trying to find?
Like, oh, I found it. Never mind. The exact number of members, like down to the.
Oh, it's down somewhere.
Yeah, I found it.
My God.
Okay, what was? Let's find out what the churn was. So
yeah,
what they say?
How many members did they lose? That's what I'm curious about.
Yeah, they did 830,000. So
net.
Yeah, net 830,000. So what they 16,000? That's not bad. 16,000. It's a lot better than the 30,000 average that we really see.
Yeah, it's been pretty lumpy, but
yeah. Q3 of 2024 was 157,000. So nice little difference there. Okay, I think I'm ready to just show off a few things. Obviously, we'll need some more plugging here, but just to show you guys what the new product ads look like. Personal loans added 133,000 new products. I thought that was going to be like 106,000. Insane. Home loans, 4,100. And you can see across that this is not seen in their growth at all. Percentage of new products that home loans did was 0.33%. And if you just track this along, them being a company, we had these numbers back in Q3 of 2021, but even then we were doing 3,200 home loans at the time, and that was with a partner. Now we're doing 4,100, so higher margin and much more activity. But the reason why the total amount of percentage of new products is lower is because we're doing better in other areas. Student loans was only 12,000, which is not as high as the quarters before it, and the originations show it.
Q2 is always down for student loans. It's just, I mean, it's always a down quarter, so not surprising.
Got you. SoFi Money, 410,000 new products. SoFi Invest, 168.7 thousand. Like, we have not seen that since here, Q1 of 2022. So that's freaking phenomenal. Credit cards, 38,000. This one's the one that I like. Focus on credit card, guys, for 2025. This is the quarters to sort of understand what's going on. So back in Q3 of 2023, we had good credit card numbers, 17,000, 21,000, 20,000, 22,000. Then it got cut in half, 9,000, 6,000, 4,000. This was a dead product. 14,000, 26,000, 38,000. That's an incredible ramp. Referred loans, 19,000 referred loans. If you see here, we did 4,000, 4,000, 5,000, 7,000, 12, 17, 19, 5. The ramp is insane. So bullish for Pagaya, I guess, as well, because SoFi's handing them loans. SoFi Relay, 431,000 new loans, and SoFi Outwork, 7,300. Not bad. Not bad. 830,000 net new member ads. Take a look at how that looks versus other quarters. 500,000, 700,000. Before, since we were tracking the data, 300,000 a quarter. Now 830,000 a quarter.
I saw Vadim just posted for the first time since Q4 2022, the cross-selling ratio of members to products is going up again.
Well, that's not true. That's not since 1 quarter ago.
Pull it up.
Yeah, last quarter I thought it increased just slightly.
It did.
Yeah,
right here.
Yeah, second quarter in a row that it's increasing.
Yes.
Yeah.
1.459. And continuing to go more financial services than lending products.
Yeah. Which is crazy because, like, in previous years, that would be like, it was consistently increasing every single quarter. And we got down to a point where it would just like stagnated. And now we're going back to increasing again.
And once, like, the other thing is level 1 options are coming. Crypto is coming.
Yeah.
We know that, like, interest-only personal loans are coming. They're probably going to roll out another new credit card or two in the next 6 months. We think that they're probably going to put like a secured credit card as well.
Hopefully, yeah.
I think, I really do think that the pace of product release will go up a lot after the core migration is done, which I hope that they talk about that. But with everything else that's going on, it'll probably fade into the background. I doubt any analysts will ask about it. Like, man.
Holy $50 donation. Thanks a million for your all consistent analysis. Tanner, Chris, Tevis, Roy, Tim, Steven, each of you deserve much more. This is my small contribution.
Sweet.
You know what I'm going to do with that? I'm going to buy SoFi stock.
2 shares.
He didn't say to put it in the community fund, but I'm going to, and it's going to go into SoFi.
It's crazy that gets you 2 shares these days. Like, what? Things are sure more expensive these days than they once were, man.
Yeah, inflation, SoFi stock inflation is going up.
Yeah, exactly.
You guys remember the days where that'd get me more than 10 shares? That'd get me like 12 shares. That was a good little piece of time where Anthony Noto was putting down millions and millions of dollars to buy his own stock.
He must be up so much on that. I haven't run the numbers recently.
I have them. Hold on.
He must be up so much on those buys. I've got the numbers.
Has a spreadsheet of Noto's stock gains.
Of course,
I've got that too. It's
do.
in my stuff. It's in mine too.
He's at $180 million of. Well, actually, I have not updated in terms of his holdings recently, so he's going to have some vested shares and everything. But in terms of his buys, including the last time that I put it at was $180 million.
That's just profit.
That's just his open.
Not just no. Hold on.
Yeah, give me the profit from where he bought.
Well, here I could do it, but I'm just lazy. These are all of his buys at the prices that they're at. So, bang. Okay. Those are all of them. But he was buying in the 9s, the 6s, in the 4s.
He went really big in the 4s.
Yeah.
Wow.
And then this, I think something's wrong here. I don't think this is.
Yeah, that didn't happen.
No.
But even still.
But I think he did buy 2 million shares at one point. I just don't think the price is right. I think maybe somehow this got adjusted, or maybe I tacked on a 1. Maybe there's at 688 or something. But I do know that there was a 2 million share buy. But yeah, that.
Holy crap! Novo
Since he's not
Nordisk is
added.
down. Sorry, Novo Nordisk is down 25%.
Oh, 26%. What happened?
It's falling off a cliff.
What happened? Hims come out and say they don't need them anymore?
I don't know, but that's nuts. I have no idea.
After Ozempic maker shock
earnings, yeah. Wegovy growth slowing.
Yeah, they cut their outlook.
Oh wow!
They must have really cut it.
Says only so. Yeah, dang. Anyway, sorry, I got distracted there. I saw a really big red number in my watch list.
UNH starting to recover, still down 1.3%. PayPal really starting to recover now after a large drop, so down 0.8%. SoFi, where's the drop, baby? Where are you, Timothy Switzer and Chiavrini and all these other analysts that, you know.
Giuliano Bologna.
Yep. That knew more than us. Appreciate it. Take your L.
New tech platform client. Argentina's largest financial institution, Banco Nacional.
Banco Nacional?
Yeah, that's cool.
Love it.
Mm-hmm.
I'll have to write my family down there.
The B-dubs, new bear case will be, these kind of growth rates are not sustainable. You guys rock. Today's a great day. Today is the quarter we've been waiting for. Congratulations. B-dubs. Thank you, brother. Appreciate you being here. Appreciate you modding for the channel. Yeah, it's absolutely insane. This is what we've been waiting for. This is what we've been waiting for. I remember saying like whenever whenever 2025 was approaching, I kept trying to highlight like we are not worried about like I'm not worried about SoFi's time will come into the future. Like SoFi's time feels like it's 2025 and now we're actually seeing it. If we end up getting a healthy amount of rate cuts now, this could be insane. Yes, ladies and gentlemen, the call is in 14 minutes. So we'll have that all up and ready to go. Unfortunately, none of us have any questions on the call. Hopefully, Chris maybe sneaks one in through an analyst, but
yeah, maybe. I posted what I would have asked yesterday.
Yeah.
Anybody who's interested. I do. So I've got to drop off. My son starts gymnastics at like the half-hour mark. So I'll switch to my phone, but I'll be back by the end of the call I'll be listening in still.
Got you. Cool. Yeah. Holy. Congratulations to a lot of the names that I see in here that have been around for quite a while. The shorts will pay.
I mean, there's not even that many shorts left, dude.
12% is still lots of shorts.
That is still quite a bit. And they're going to have to cover, like, if they keep doing this, they're just going to have to cover at a loss, right? Like, at some point, they'd have to buy those shares back.
Wood says, my brain is smooth. Can you please explain how good these numbers actually are and put it into perspective? Anyone want to take a shot?
for a smooth brain? I don't know.
Yeah.
Like, okay, put it this way. All of our estimates were like $30 million above Wall Street estimates, and the results were like $30 million above our estimates, right? Like in terms of revenue growth. We like everybody here was like, maybe we'll get 40% year-over-year growth, and they got to like 44% year-over-year growth. But and the thing is that it's not just one segment. I'm doing my best to put this in the right way. It's not just one segment that's outperforming. Like lending was up, financial services was up, and for the first time ever, when all of us completely wrote off the tech platform, right? Even it was up a decent amount. So the whole business across the entire bit, we've tried to find something to nitpick on this stream the entire time, and we can't even find something to nitpick really at this point. Like across the board, everything was good.
It truly was something special watching this. And you know what? Once we start getting data for July, August, September, see how they continue to grow. If they can hold this momentum, this is the greatest thing about investing is there's been some people who are buying at 4, there's been some people who are buying at 20, 21, etc. Is that if you have a winner, there's no need to try to, this is from my time horizon, my type of investing style, is that once you have a winner, why try to trim it to water something else that's not working? If UNH or Novo Nordisk or some of these other positions that people might be playing in, why try to play those whenever you can buy a company that continues to blow away the most bullish analyst outlooks? Okay. Even StockGoat knows he's bullish. Everyone knows this, but yet the numbers that were shown were putting StockGoat to his price targets going, hey, you know what? If they keep this up, 45 is not going to be high enough. You're going to have to adjust that. You go back to the 75s and the 85s, because obviously 44 will be a hard target to hit. But if they continue to see this level of member growth going forward, holy. And that's what Anthony Noto said, by the way, like maybe 2 years ago. He said in the next 2 years, I expect that we're going to start seeing per quarter about 800 to 1 million members per quarter going forward. And now, 2 years later, we're seeing 800 creeping up to 900, maybe 1 million per quarter.
I think we take out the IPOE all-time highs easily this year.
Yeah, no, definitely.
IPOE all-time highs.
Yeah, I think we get above 28.
Mm-hmm.
I think it was 28.26 or something was like the all-time high.
10 May says, is it good enough for a 10% pop today, though? People said it would triple beat because the stock is so hated. It's still going down at open. Well,
I mean, it's up 10% right now.
Yeah,
Almost.
it's up 9.3% right now. It just almost touched $23.
yeah. So whenever the market opened, it definitely was, I mean, we have seen quarters where the pre-market is not determinant of what the
There it is,
just hit
23.
10%.
Yeah, I think like obviously the call is going to determine a lot. The analyst questions and what management is asked around
But
guidance.
bro,
and such.
honestly, when have we ever heard Anthony Noto say something that is taken away from the bull case? He always adds things to add, like the stock can run on Anthony Noto's comments. Unless he says something stupid like this, don't expect this level of growth going forward. This was a really great quarter, something like that. But he's not going to.
Yeah,
He
that's what I
expects
mean.
50 million members long term, like over the next 5 years or whatever. He's going to expect this level of execution every quarter.
Yeah, I meant it like on the bullish side. Like it could run past 10% on the call, depending on what they say to analyst questions.
We're past 10%. We're at 11%.
Well,
Or sorry, no. This is from where I'm looking at.
Now we're past 11%. It just jumped.
Yeah, 11%. Yeah, 23.35. Why are we not celebrating this? What
This
is
awesome?
Chris? What did you say was the highest for SoFi for SoFi, not IPOE? What is SoFi's high? It's 23 something, right?
I think it's just under. It's right around 25. I'll tell you in a second. I have it.
We're at 23.46 right now.
24.65. We could take it out today.
If you have a true compounder that just continues to execute quarter over quarter, the market will have to recognize. We've been saying this quarter after quarter. In the short term, people can vote on what they think SoFi is going to do, but at the end of the day, it's going to come down to what they're actually posting as their numbers. And whenever you get this large of a beat, like what we said, if Roy is right on financial services, if there's any way that he's crazy enough to be right on financial services and the tech platform beats or something else beats, we are going to see an unbelievable day. And he wasn't bullish enough. That's unbelievable.
The highest ever close for the ticker SoFi is 23.29, and we're at 23.15.
So we could open the highest SoFi has ever seen.
We broke it. We went to 23.49 just right now.
Yeah, but these aren't
That's
real
the
numbers
highest
yet.
daily close. It's not the intraday high, but like today could be the highest that SoFi the ticker has ever closed. If we get above that number.
You know how I knew this was going to happen is because Tevis said that we were going to close the week at 1950.
You only have covered calls on a portion of your holdings, right, Tevis?
Yeah, definitely not all of them. And I also have, I'm definitely fine. But we have seen this before. We have seen it run 10% of the market before.
Yes.
But the quarter was never this outstanding.
Yes, that's correct. But I'm just saying, like...
No. Yeah, you're totally right. We could drop to 18 for some crazy reason. And if we do, I'm buying.
Oh, yeah. I'd be buying, too. I think Tanner yesterday asked me, like, hey, what price would you buy? And I said, well, it depends. But, like, this was a really good result. And I think, like, it's just crazy, man, to see this, like, try to extrapolate out a year and see where this business is going to be with regards to the fee-based revenue and the growth rates. And you're like, okay, well, we're not bullish enough.
Yeah, but then cut the price target in half because they're a bank, right? Not a tech company.
Oh, yeah, that's true. They can't grow because they're a bank.
Yep, can't grow. Can't grow. So we're only putting up numbers like 44%, which is, I don't know. I was going to say a bunch of tickers. I'm not going to say. I'll leave Chris to tweet about it later. Anyway, holy crap, guys. This is just crazy. And the greatest part, no one's forcing us to sell. Like, this is why I remember like the other days, people were like, yeah, but what if SoFi posts double misses tomorrow and we're all wrong. I'm like, it'll be the first time. Like, I don't know. If things happen, I'm getting a little hot hand fallacy with SoFi. Like, I feel confident with this company in Anthony Noto's hands. And if he sticks around, I'm going to expect maybe not this level of execution, but a triple beat level of execution. The amount that the guidance was raised quarter over quarter is insane.
Okay, like if we're being honest, it's only raised that amount because it was a sandbag number to start with.
Yes, but analysts believe that number.
But
Analysts are
idiots.
under that number.
Well, no. On full year, I think they were at that number.
I think you're right. They were like right at it.
They're like 28
You
cents.
know this. Like I don't understand why we're basing our like analysts have historically been wrong about SoFi.
I'm not worried about me with analysts. I worry about the market with analysts. So many people bring up free cash flow stuff like this for SoFi. So, you know, some people take quick glances at stocks and they determine whether they think that it's worth a buy or a sell based on what analysts have to say.
Even Steve, like Steve always pulls up all the analyst expectations
all the time.
All the time. That's what he bases almost all of his future analysis on, right? Even though I love Steve, right? But that
for names that he's not looking into.
Right. Yeah. But even for SoFi, right? Like and Google and Apple and stuff. But even anyway, like analyst numbers make a big difference. And they're all going to have to upgrade after this.
Well, we assume that.
Well, they'll have to upgrade their numbers. They're not gonna. They might say it's run too much and it's still a hold or whatever, right? But the actual, if you look at the earnings and revenue estimates, like they're gonna go up.
The thing is that I really do think that there was a comment before that said, where was it? The new bear case is going to be that. These kind of growth rates are not sustainable. I do actually think the big bear cases are going to say that the amount of originations that they're doing is not sustainable, but it won't matter because the loan platform exists and they'll be able to push a lot of those loans to other banks and other asset managers.
I do wonder if this was an expansion of the credit box because we got such a big number.
Mm-hmm.
I don't know if they can originate this, like, you know, almost 7 billion loans if they're not expanding the credit box. Maybe they can. Maybe I'm wrong. But I wonder if we get any commentary about that.
We're definitely going to get commentary about it. That's been the big thing that Anthony Noto has said recently. By the way, Daniel started investing at 22 years old 2 years ago, and just wanted to say thank you guys for the good information on SoFi. The ups and downs, accumulated about 35,000 shares in SoFi is by far my biggest position. Daniel, gotta love whenever your biggest position's up 10% in the pre-market. Congratulations, brother. Thank you for the donation. The generosity is just crazy today. You guys don't have to do that. Honestly, I'm making enough money as it is through SoFi going up right now. So we're all square. Thank you. Holy.
Shall we flip to the call?
Call starts in 1 minute.
Oh gosh.
We got too excited.
I'm not ready.
It's okay. The prepared remarks. You got a few minutes of them talking about.
Right.
Got some music to listen to, and
yeah. Dang, guys! Congrats.
Okay, I'm in.
It's been a journey. This is awesome.
Okay, we're all ready to go.
Chamath said congrats. I love that.
Oh, did he for real?
Yeah, he responded to Noto and Noto retweeted him.
What's that? There's a company that does the earnings calls. They share the earnings calls, but they also show the ticker symbol over it.
Order?
No, I think it's like
Is it Say?
No, it's like one of those places that like it's not Motley Fool. It's another one where people write articles in and
Seeking Alpha?
No, another one.
Substack?
No.
All right, we'll throw up the call and we'll
Just
figure
pull
out.
up the call, and you can
Yeah,
search for
it's just music right now. I'm not going to throw up the
Earnings
music.
Hub?
Okay.
I'm
Earnings
listening. I'm not throwing up the call.
Earnings Hub, StockTwits. Oh, StockTwits maybe actually.
I mean, we can check that. I thought it was a guy's name, something like maybe Maybe I've gone crazy. Okay. By the way, the call is still just music.
Whoa,
Okay, just
there was
switched over.
just a 4 million volume candle in the pre-market.
Oh wait, never mind. They said it's going to begin in like a minute. It started going back to music. Yeah, it's Benzinga. That's what I think it is. I think they have the earnings call with the price behind it, and you can watch both. If I can get that up. If not, sorry, ladies and gentlemen. It's just going to be.
Travis, what are you going to do with your winnings from Matt Money? That's what I want to know.
Probably pay down my covered call, honestly. No, I'll
should have just
probably.
bought SoFi shares with it.
I'll probably just like whenever I see Matt, we'll just grab a dinner or something. And it's not Elijah. It's not 500 Canadian dollars. It's 500 USD. Because Matt, so I said, is it 500 Canadian? And when SoFi was at $12, Matt was like, absolutely not. It's 500 USD. And now I'm reminding him of the same fact.
Yeah, he was about to pay you in Monopoly money.
Yeah, exactly.
I love how you guys mock your own currency.
Okay, I think it's starting.
All right, I'm gonna go silent on you because I'll be running around, but I'll be listening.
Have been placed on mute.
Sure hope so. It's
Background noise.
we're listening to a call.
After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, please press star followed by 2. Thank you. And with that, you may begin your conference.
Thank you and good morning. Welcome to SoFi's second quarter 2025 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release in the investor relations section of our website. Unless otherwise stated, we'll be referring to the adjusted results for the second quarter of 2025 versus the second quarter of 2024. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-Q filing, which will be made available next month. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our subsequent filings made with the SEC, including our upcoming Form 10-Q. Any forward-looking statements that we make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now I'd like to turn the call over to Anthony.
Thank you and good morning, everyone. We had an excellent second quarter as we continue to drive durable growth and strong returns through our relentless focus on product innovation and brand building. Our one-stop shop strategy is stronger than ever, further accelerating our year-over-year growth in adjusted net revenue to 44%, the highest growth rate in over 2 years, and driving a 5.6 times year-over-year increase in earnings. I'll begin by covering our key results for the quarter, starting with our durable growth, which continues to be driven by the growth of members and products. We added a record 850,000 new members in Q2, increasing total members by 34% year-over-year to 11.7 million SoFi members. We also added a record 1.3 million new products, representing 34% year-over-year growth to over 17 million products. Cross-buy remained strong in the second quarter, with 35% of new products opened by existing SoFi members. We have proven once again that our strategy is successful in driving new members to SoFi and getting existing members to do more with us. Our strong member and product growth powered our revenue growth in the second quarter. Adjusted net revenue was a record of $858 million, up 44% year over year. Together, our financial services and technology platform segments generated $472 million of revenue, up 74% year over year, and now representing 55% of total revenue. In our lending segment, adjusted net revenue grew 32% year over year to $447 million, driven by strong originations in the segment of $6.3 billion, up 18% from the prior year. Combined with the very strong $2.4 billion of originations in the loan platform business, total originations reached a record of $8.8 billion for the second quarter. This is an increase of $1.5 billion from just last quarter. Total fee-based revenue across our business was also a quarterly record of $378 million, up 72% from the prior year. This was driven by strong performance from our loan platform business, origination fees, referral fees, interchange revenue, and brokerage fee revenue. On an annualized basis, we are now generating over $1.5 billion of fee-based revenue, reflecting the deliberate diversification of our business towards more capital-light revenue streams. In addition to delivering durable growth, we delivered strong returns and profitability. In the second quarter, all three segments delivered record contribution profit at attractive margins. Adjusted EBITDA for the quarter was a record of $249 million, up 81% year over year. Our adjusted EBITDA margin for the quarter was 29%. Our incremental EBITDA margin was 43% as we continue to balance reinvesting in the business to drive long-term growth and profitability. Net income for the quarter was $97 million at a margin of 11%. Earnings per share were 8 cents. Finally, our tangible book value ended the quarter at $5.3 billion, a year-over-year increase of over $1 billion, and a quarter-over-quarter increase of nearly $200 million. This strong financial performance is driven by our consistent, disciplined investment across our diverse portfolio of businesses focused on building a trusted brand name, continuously enhancing existing products, and developing new products to help our members get their money right. As the only one-stop shop for digital financial services, our investments can drive greater long-term growth because we have more ways to attract members to our platform and more ways to grow with them once they're here. Let me give an example of how this works. A member may come to us through SoFi Relay, a free product that analyzes a member's finances and provides tangible options for how they can spend less than they earn so they can invest the rest. For perspective, it costs less than $15 to acquire a SoFi Relay member. Based on the ease of use and the quality of the insights, this member decides to move their checking and savings accounts from a big bank to our SoFi Money product. To get our best APY, the member enrolls in direct deposit, instantly making them a SoFi Plus member with access to our best benefits, including unlimited access to financial planners, loan discounts, more rewards, and unique experiences. This member instantly goes from earning just 2 basis points of interest at the big bank to earning 3.8% at SoFi. So on $10,000 of saving deposits, they earn about $380 in annual interest compared to just $2 at the big bank. With this extra cash in hand, the member opens a SoFi Invest account, taking advantage of the 1% match on recurring investment deposits, paid in reward points, another benefit of their SoFi Plus membership. Later, the same member sees a recommendation in their home feed to consolidate credit card debt, where they are paying north of 20% interest, into a SoFi personal loan at a rate in the low teens, resulting in more savings. The member puts the money they save on a lower cost loan in a SoFi Vault to save for a down payment on a home and take advantage of our home lending product. Every day, stories like this unfold as members turn to SoFi products for every major decision in their financial lives and every day in between. Along the way, we're creating lifelong relationships that deliver real financial value to our members and to our business. Because these relationships often stem from just one initial product with one acquisition cost, we generate significantly more favorable unit economics. In the example above, we would generate a variable profit of about $1,800 on the personal loan before even considering the opportunity to grow the relationship with the home loan or other products. As we do more with each member, we drive a higher lifetime value, which is our sustainable competitive advantage and allows us to continuously reinvest in our business to provide better products, lower interest rates on loans, higher rates on savings accounts, boost on recurring investments, and even more free financial services, and in turn, driving the power of our virtuous cycle. The concrete result of this virtuous cycle is superior compounded growth over the last 5 years, including nearly 50% revenue growth, member growth of 58%, and product growth of 60%. Despite the significant growth we have achieved to date, we are just getting started. The existing opportunity in front of us is massive, and the opportunity is growing through our own innovations to expand our addressable markets and by rapidly advancing technology. In fact, we are at an unprecedented point in time with 2 technology supercycles taking place. Crypto and blockchain, as well as AI, have the power to completely reinvent the future of financial services. As a tech-forward digital one-stop shop, we are uniquely positioned to capture the opportunities presented. Let me take a moment to discuss some of our recent investments in these areas, as well as our ongoing investments in brand building and product innovation across our platform. Starting with crypto and blockchain, I am very excited that during the second quarter, we announced the first 2 of many planned crypto and blockchain innovations across our products and services. First is self-serve international money transfers, which will allow SoFi Money members to seamlessly and securely transfer money to people in dozens of countries, whether it's to support family abroad or make purchases outside the US or manage their money across borders. These transfers will be fully automated in the SoFi app at significantly faster speeds and lower costs compared to traditional services, putting more money in people's pockets faster. And these transfers can also be done by businesses. Here's how it works. A member deposits funds in their SoFi Money account. Through the SoFi app, they initiate a transfer by entering the recipient and the amount to send in US dollars. Funds are automatically transmitted on a secure, well-known blockchain network and converted into local currency at the destination, then rapidly deposited into the recipient's account in the fiat currency of choice. This process is fast and easy. It can take under a minute, and it will be done with full transparency with exchange rates and fees upfront, and it will be available 24/7 in the SoFi app. And you can imagine the day when the SoFi app is deployed internationally for payments coming from non-US countries to the US. The ability to leverage blockchain technology to send money internationally is yet another enhancement of SoFi's unprecedented money movement offering. The second crypto-related innovation is our return to crypto investing. We are excited to once again be able to provide members with the ability to buy, sell, and hold a selection of cryptocurrencies like Bitcoin and Ethereum. In a recent survey of our members who invest in crypto, we found that 60% would prefer to work with a nationally licensed bank like SoFi over their current primary crypto exchange. This is another benefit of having a bank license, and yet another way we are providing our members options to invest for their future. We now offer members the ability to buy and sell single stocks without commissions or fees, our award-winning robo-advisory products, SoFi branded ETFs, IPOs at IPO prices, alternative investments including new private market funds from asset management firms including Cashmere, Fundrise, and Liberty Street Advisors, which we added this month, and soon crypto. Both self-serve international money transfers and crypto investing are expected to launch later this year, with more innovations to come. Crypto is a key area of focus for our management team, and when we have brought on board significant expertise, including substantial engineering talent, to advance these new initiatives. The cost, speed, and security of paying, buying, and spending are worse today than they will ever be in the future. Faster, safer, and cheaper options will only get better and better every year. Over time, we see opportunities across our entire platform, including offering stablecoins, providing members the ability to borrow against their crypto assets, expanding payment options, and introducing new staking features, as well as blockchain and digital asset infrastructure capabilities for other companies offered by our technology platform. Blockchain and crypto have the potential to be a game changer for SoFi and our members. Turning now to AI. We're implementing and testing AI applications across our business, from enhancing back office processes like dispute resolution and filing suspicious activity reports, to improving how we interact with our members to help them get their money right. And we've brought on teams of engineers to drive these efforts forward. One specific member-facing application that I am particularly excited about is Cash Coach. Cash Coach will be a part of our Relay product and will look across your cash held at SoFi and elsewhere and tell you how much you actually have, how little you might be earning at other institutions, and how you can optimize your cash to drive a better return. Cash Coach is just the beginning. In the future, we plan to roll out coaches across our platform to help members understand what they must do, what they should do, and what they can do across their financial lives every day. Let me now shift to our brand building efforts, which are key to establishing SoFi as a trusted household name. These investments increase the overall awareness of SoFi and have a halo effect that makes our performance marketing of each product more efficient. During the second quarter, we unveiled our first ever music partnership as the presenting partner of the Country Music Association's CMA Fest, the world's largest and longest running country music festival. Beyond the exposure of having our name appear everywhere the CMA Fest brand goes at the festival and on broadcast, we also offered exclusive perks to SoFi Plus members, enriching the value of our premium membership offering. We've also partnered with award-winning artist Kelsey Ballerini across our marketing channels to inspire others about the importance of reaching financial independence. Together, our marketing efforts drove unaided brand awareness to an all-time high this quarter, reaching 8.5%, up from 7% last quarter. Turning now to product innovation within our segments, starting with the financial services segment and the loan platform business, which is having a profound impact on our business overall. As a reminder, LPB leverages our customer acquisition, operations, and service capabilities to originate customized loan portfolios on behalf of third parties. We typically move these loans through our balance sheet in a matter of days, so they don't require additional capital, and we do not retain any credit risk after transfer. With LPB, we collect a fee for each loan transferred, supporting our strong growth in fee-based revenue. Prior to the second quarter, the vast majority of our LPB volume consisted of loans within our prime credit box, but over and above the volume we want to put on our balance sheet. However, during the second quarter, we meaningfully increased the proportion of loans that are near prime with higher WAC, effectively monetizing more of the roughly $100 billion of loan applications that we are not able to meet each year. This expansion, along with the large agreements that were previously announced, helped drive record LPB origination volume of $2.4 billion, an increase of 57% from just last quarter. On an annualized basis, after just 1 year, this business is running at a pace of over $9.5 billion of originations and over $500 million of high margin, high return fee-based revenue. It is now bigger than our student loan refinancing business, our first business, and we see further upside still. We remain incredibly optimistic about the loan platform business, which continues to move closer to becoming a billion-dollar revenue business. As we look further down the road, we see the potential to tokenize SoFi loans to make them more widely available in liquid markets in increments of dollars rather than tens of thousands of dollars, such that anyone can invest in loans just like they do equities. Turning to our tech platform segment. This business has been instrumental in our ability to innovate across the SoFi platform. It allows us to more rapidly develop, test, and roll out new products while also providing significant cost savings versus relying solely on third parties. For example, SoFi uses the tech platform's Cyber Bank Connector, an AI-powered virtual personal banking assistant, to provide seamless support to members across digital channels and reduce operational costs. This adoption has led to a 65% faster average response times and cut our chat abandonment in half. Tech platform innovation is not only helping SoFi, but our clients overall. Banco Nación, one of Argentina's largest financial institutions, selected our Cyber Bank digital platform to modernize their digital banking infrastructure. The implementation, which started with corporate banking, has already resulted in a 25% increase in organic client growth and reduced implementation time from months to just 4 business days. They've now positioned themselves to unify mobile and desktop banking systems for over 10 million consumer banking customers as well. We also continue to make strong progress diversifying our client base beyond traditional financial service firms and fintechs. Earlier this year, Tech Platform launched a first-of-its-kind reward debit program with Wyndham Hotel and Resorts, and we've signed 2 additional travel and hospitality companies that are expected to launch before the end of this year. In total, we anticipate having approximately 10 new clients that contribute revenue in Q1 2026 that did not contribute revenue in Q1 2025. Now turning to our lending segment, where we had another fantastic quarter of originations. Despite this being our longest-standing business, we see significant growth opportunities across our loan types and are enhancing our product offering to capture them. For example, we are already leaders in the personal loan market with roughly 15% of the prime segment. However, we know that the top use of a personal loan is to refinance expensive credit card debt, which makes the real addressable market much larger. Americans in the prime credit category have over $700 billion of outstanding credit card debt, which means that the true opportunity is a large multiple of the volume that we are currently originating. This is one reason why in the second quarter we launched a new personal loan product for prime credit card customers that carry a revolving balance and are making mostly interest-only payments. While it's very early days, we are pleased with the interest in this product and to be generating awareness among members that SoFi can help them get their money right instead of being gouged by our competitors. In student loan lending, we had another strong quarter with nearly $1 billion of originations, up 35% from a year ago. Given the evolving student lending landscape, in the second quarter, we launched a refinancing solution which allows for lower payments in the early part of the loan and steps up into paying regular payments after this introductory period. This allows members to find their footing and build long-term savings, and it's another innovative way we are targeting the estimated $280 billion of student loans that can currently be refinanced at a more attractive rate. With the elimination of the government's Grad Plus program and the capping of the Parent Plus program, we see further opportunities for in-school lending and student loan refinance. Turning to home lending, total home loan originations reached nearly $800 million in the second quarter. This is an increase of more than 90% year over year, despite the elevated rate environment. One key driver of this growth has been our home equity loan offering, a particularly attractive product in this high rate environment. In the second quarter, we had our best quarter of home equity originations, surpassing last quarter's record. This product, which we didn't have a year ago, accounted for nearly 1/3 of our home lending volume. As interest rates come down, we are planning for an acceleration in demand for both home purchase and refinance. To put the opportunity in perspective, we have nearly 3 million members with a home loan held at another institution, and we believe we are well positioned to capture a significant portion of the refinance volume as the rate environment improves. Our success in the second quarter is clear validation of our strategy and execution. And as you can see, we are just scratching the surface of the tremendous opportunities for growth that exist across each of our products and segments. Furthermore, the opportunities are growing, driven by both our ability to expand our addressable markets through our innovation and the rapidly advancing technology, including blockchain and AI. As the only digitally native one-stop shop for financial services, we are uniquely positioned to capture the increasing opportunities on our way to becoming a top 10 financial institution. I assure you that our team is working tirelessly to add even more value to members and to seize the opportunity in front of us. With that, let me turn the call over to Chris.
Thank you, Anthony. It has been a strong start to the year as we continue to drive durable growth and strong returns. We exceeded each metric that we guided to on our last call on the way to delivering accelerating revenue growth in our 7th consecutive profitable quarter. For the quarter, revenue accelerated and grew 44% year over year to a record $858 million. Adjusted EBITDA was also a record at $249 million and a margin of 29%. Net income was $97 million at a margin of 11%. and earnings per share was 8 cents. This included a small benefit of about a penny related to a lower than expected effective tax rate. An important driver of the acceleration of growth was the increased contribution from capital-light non-lending as well as fee-based revenue sources. Our non-lending businesses generated $472 million of revenue, up 74% year over year, and we also generated record fee-based revenue across all businesses of $378 million, up 72% year over year. Turning now to our segment performance. In terms of financial services, for the second quarter, net revenue was $363 million, more than double that of Q2 2024. Contribution profit was $188 million, up nearly 3.4x from last year. And contribution margin was 52%, up from 31% last year. Net interest income for this segment was $193 million, up 39% year over year, which was primarily driven by growth in member deposits. Non-interest income grew nearly 4.6x to $169 million in the quarter, which equates to over $650 million in high-quality fee-based income on an annualized basis. Importantly, improved monetization continues its strong contribution to revenue growth. Financial services revenue per product increased from $64 in the second quarter of 2024 to $98 in the second quarter of 2025. That's up over 50%, and we see continued upside as newer products mature. In Q2, our loan platform business generated $131 million in adjusted net revenue, up 36% from just last quarter. Of this, $127 million was driven by the $2.4 billion of personal loans originated on behalf of third parties as well as referrals. Additionally, LPB generated $3 million from servicing cash flows, which is recorded in our lending segment. The growth opportunity for this business continues to be very strong. In addition to our LPB revenue, we continue to see healthy growth in interchange, up 83% year over year, driven by close to $18 billion in total annualized spend in the quarter across money and credit card. Shifting to our tech platform. For the second quarter, we delivered net revenue of $110 million, up 15% year over year. Contribution profit was $33 million at a contribution margin of 30%. Revenue growth was driven by continued monetization of existing clients, along with new deals signed in new client segments. Turning now to our lending segment. For the second quarter, adjusted net revenue was $447 million, up 32% from the same period last year. Contribution profit was $245 million, with a 55% contribution margin. These strong results were primarily driven by growth in net interest income, which increased 33% year over year to $373 million. During the quarter, we had record total loan originations of $8.8 billion, up 64% year over year. Personal loan originations were a record at $7 billion, of which $2.4 billion was originated on behalf of third parties through LPB. In total, personal loan originations were up 66% year over year. Student loan originations were $993 million, up 35% from the same period last year. And home loan originations were $799 million, a year-over-year increase of more than 90%. Capital markets activity was very strong in the second quarter. We sold and transferred through our loan platform business over $3.4 billion of personal and home loans. In terms of personal loans, we closed $201 million of sales in whole loan form at a blended execution of 105.8%. All deals had similar structures to other recent personal loan sales, with cash proceeds at or near par, and the majority of the premium consisting of contractual servicing fees that are capitalized. These sales included a small loss share provision that is above our base assumption of losses and immaterial relative to the exposure we would have otherwise had if we held on to the loans. Additionally, we sold $90 million of late-stage delinquent personal loans. By selling these loans, we're able to generate positive incremental value over time versus selling after they charge off, both from our improved recovery capabilities and by maintaining servicing. In terms of home loan sales, we closed $779 million at a blended execution of 102.2%. In addition to our personal loan and home loan sales, we executed a $690 million securitization of loans originated through our LPB business, our second securitization of collateral originated through LPB. Importantly, this channel provides our partners with meaningful liquidity to support their ongoing investment in the loan platform business. The transaction priced at an industry-leading cost of funds levels with a weighted average spread of 101 basis points. Turning to credit performance, the health of our consumer remains strong, and we're not seeing any signs of weakness. Our personal loan borrowers have a weighted average income of $161,000 and a weighted average FICO score of 743, while our student loan borrowers have a weighted average income of $136,000 with a weighted average FICO score of 768. Our credit trends continue to be strong after seeing delinquencies peak early last year. For personal loans, the on-balance sheet 90-day delinquency rate was 42 basis points in the quarter, a decrease of 4 basis points sequentially. The annualized charge-off rate also declined to 2.83% versus 3.31% in the prior quarter. Had we not sold any late-stage delinquencies, we estimate that including recoveries between 90 and 120 days delinquent, we would have had an all-in annualized net charge-off rate for personal loans of approximately 4.5% versus 4.8% last quarter. For student loans, the on-balance sheet 90-day delinquency rate was in line with last quarter at 13 basis points. The annualized charge-off rate for student loans increased 47 basis points to 94 basis points. This was primarily due to a few discrete items. First, we switched servicers for our student loans, which resulted in some charge-offs being delayed from Q1 to Q2, as well as some customer payment disruptions in the second quarter. Second, we purchased a portfolio of student loans at the end of Q1 that have had a higher charge-off rate in line with our expectations at the time of purchase and reflective of the price we paid for those assets. Excluding those items, normalized charge-offs across the first and second quarters would be approximately 64 basis points in Q1 and 68 basis points in Q2, in line with previous quarters, and we expect normalized levels going forward. The data continues to support our 7 to 8% maximum life of loan loss assumption for personal loans, in line with our underwriting tolerance, although we continue to trend below these levels. Our recent vintages originated from Q4 2022 to Q3 2024 have net cumulative losses of 4.23%, with 41% unpaid principal balance remaining. This is well below the 5.75% observed at the same point in time for the 2017 vintage, the last vintage that approached our 7 to 8% tolerance. The gap between the newer cohort curve and the 2017 cohort curve widened by a more favorable 19 basis points after a widening improvement of 16 basis points in Q1. Additionally, looking at our Q1 2020 through Q1 2025 originations, 60% of principal has already been paid down, with 6.7% in net cumulative losses. Therefore, for life of loan losses on this entire cohort of loans to reach 8%, the charge-off rate on the remaining 40% of unpaid principal would need to be approximately 10%. This would be well above past levels, further underscoring our confidence in achieving loss rates below our 8% tolerance. Turning to our fair value marks and key assumptions. As a reminder, we mark our loans at fair value each quarter, which considers a number of factors, including the weighted average coupon, the constant default rate, the conditional prepayment rate, and the discount rate, comprised of benchmark rates and spreads. At the end of the second quarter, our personal loans were marked at 105.7%, up 28 basis points from the end of the prior quarter. This change was primarily a function of the discount rate decreasing by 20 basis points to 4.67% due to the underlying benchmark rate decrease by 25 basis points and spreads widening by 5 basis points. As we've previously noted, both of these changes are empirical based on actual market data, not assumptions. Additionally, any fair value impacts that resulted from interest rate changes were offset nearly 1-for-1 by hedges. Additionally, the annual default rate decreased by 9 basis points and the conditional prepayment rate decreased by 8 basis points. Slightly offsetting these impacts was a 13 basis point decrease in the weighted average coupon. At the end of the second quarter, Our student loans were marked at 105.8%, up 61 basis points from the end of the prior quarter. This change was a function of the discount rate decreasing by 25 basis points to 3.97%, driven by the underlying benchmark rate decreasing by 27 basis points, partially offset by 2 basis points of spread widening. Slightly offsetting this impact was a 35 basis point increase in the conditional prepayment rate and a 3 basis point decrease in the weighted average coupon. There was no material change to the annual default rate. Turning to our balance sheet. In the second quarter, total assets grew by $3.4 billion, driven by $3.1 billion of loan growth and approximately $220 million of growth in cash equivalents, and investment securities. Total company-wide cash at quarter end was $2.7 billion. On the liability side, total deposits grew by $2.3 billion to $29.5 billion, primarily driven by growth in member deposits. Net interest margin was 5.86% for the quarter, down 15 basis points sequentially. This included a 24 basis point decrease in average yields as we saw a modest mix shift from personal loans to student loans, which was partially offset by an 11 basis point decrease in cost of funds. We continue to expect a healthy net interest margin above 5% for the foreseeable future. In terms of our regulatory capital ratios, we remain very well capitalized. Our total capital ratio of 14.4% at quarter end remains comfortably above the regulatory minimum of 10.5%, as well as our additional internal stress buffer. The quarter-over-quarter change in capital was driven by the strong loan growth during the quarter. Tangible book value grew $194 million sequentially to $5.3 billion. And tangible book value per share at quarter end is $4.72, up from $3.94 a year ago. Let me now finish by providing our revised outlook for 2025. Given our strong first half of the year, for 2025, we now expect to add over 3 million members, which represents approximately 30% year-over-year growth. We now expect adjusted net revenue of approximately $3.375 billion, above our prior guidance of $3.235 to $3.310 billion. This equates to year-over-year growth of approximately 30%, an increase from our prior guide of 24 to 27%. We now expect an adjusted EBITDA of approximately $960 million, above our prior guidance of $875 to $895 million. This represents a 28% margin. We now expect adjusted net income of approximately $370 million, above our prior guidance of $320 to $330 million. And adjusted EPS of approximately 31 cents, above our prior guidance of 27 to 28 cents. We now expect growth in tangible book value of approximately $640 million for the year, above our prior guidance of $585 to $600 million. Overall, it's been a strong first half of 2025, and we're looking forward to a great second half. Let's now begin the Q&A.
At this time, I would like to remind everyone, in order to ask a question, press star and the number one on your
Absolute
telephone
slam
keypad.
dunk so far.
Please keep in mind, we'll take only one question per person at a time, and please rejoin the queue for any additional questions. Our first question today comes from John Hecht from Jefferies. John, your line is open. Please go ahead.
Thanks very much, and congratulations on another good quarter, guys. I'm just, maybe a broad question about guidance. You've given full year guidance, but I'm wondering if there's anything you can share about the cadence from the third and the fourth quarter, maybe all the way to the segment level, if there's any changes there in terms of the contribution. And then, you've given medium-term guidance. I'm wondering, maybe you could give an update on that or your confidence around achieving that. And thanks very much.
Yeah, thanks, John. So overall, we're really pleased to be able to raise our 2025 guidance. In terms of some of the segment level specifics, for financial services, what we had previously guided to was 60 to 65% year-over-year growth. We're obviously pacing well above that, and we expect that to continue in the back half of the year. For both tech platform and lending, what we'd originally guided to was low double-digit to teens year-over-year growth in 2025, and we remain confident in that.
And then in aggregate, what you should expect is for Q4 to be higher than Q3 across all of our metrics: revenue, EBITDA, net income, and EPS. In terms of our medium-term guidance, what I would say is we feel really good about it. We continue to expect to exceed 25% compounded annual revenue growth from 23 to 26. And we really remain confident in delivering our EPS target of 55 to 80 cents in 2026. What I would say is that the mix of our business continues to change meaningfully. And as such, our outlook for each respective revenue segment is going to change. And we're going to update our outlook when we give our detailed 2026 guidance. But at a high level, our mix and growth expectations are changing given the real-time opportunities that have presented themselves, including faster than expected adoption of our LPB business. And what's even more significant than that is participation by LPB investors outside of our credit box. In addition to that, some of the news that we got on the OCC that certain crypto activities are permissible and the implications for large banks and their tech decisions based on recent regulatory climate, both also impact our outlook. So suffice it to say, these opportunities and dynamics have changed our priorities and how we've allocated resources thus far in 2025 and how we're thinking about allocating resources in the second half of this year and into 2026. So overall, the mix and drivers are likely to change, but we remain even more confident in the aggregate outlook of 25% or more of compounded annual revenue growth from 23 to 26 and EPS in the range of 55 to 80 cents in 26.
And John, I would just add, we feel great about the business. It's operating on all cylinders. The results show that. Our outlook shows that for 2025. I think our biggest challenge beyond 2025, quite frankly, is deciding what not to do. There are more opportunities on the table for us than ever before. It feels like we're just getting started, even though we've been at this for 8 years and have delivered good, consistent growth over that time period. Our goal and prioritization will be to allocate resources to those segments and those businesses that can drive the best compounded growth over decades, as opposed to just a couple of years, with the overall goal of an ROE that's 20 to 30%. So as Chris mentioned, there's a few things that turned out to be a lot bigger opportunities sooner than we thought, and we're going to allocate resources to those. We hope to be able to allocate resources to everything, but that's unlikely, but feel great about the outlook.
The next question comes from Dan Dola from Mizuho. Dan, your line is open. Please go ahead.
Hey, good morning, Anthony and Chris. So epic results here. Congrats on our end. Can we quickly discuss the tech platform and the Chime migration? That's been a topic that we've been getting a lot of questions on. So specifically, is the migration complete and what is the impact on the overall account? So thanks again for any color.
Sure, I can take that, Dan. So we don't give guidance on tech platform accounts. What we have guided to is low double-digit to teens revenue growth for the tech platform in 2025. And as I just mentioned, that expectation has not changed up until this point. While migration is not complete, we have made really good progress on signing up new partners that are going to contribute in 2026. And the exact give and take of those new partners coming on board and the loss of any existing partners will be firmed up by year end. And we'll give a new update on guidance for all the in and outs after our Q4 2025 earnings call. We do anticipate, as we've mentioned previously, having approximately 10 new clients that are going to contribute revenue in Q1 2026 that did not contribute revenue in Q1 of 2025.
The next question comes from Andrew Jeffrey at William Blair. Andrew, your line is open. Please go ahead.
Hi, good morning. Appreciate you taking the question. Chris and/or Anthony, whoever wants to take it. Can you talk a little bit about sort of anticipated funding mix going forward? This was a very strong origination quarter, obviously across the board, and the loan platform business is ramping really nicely. But you also had excellent deposit growth. So I just wonder if you can help us a little bit recognizing the very high, like sort of basically infinite returns on capital from the platform business versus the balance sheet and sort of how you think you're going to use each going forward to sustain your growth.
Yeah, Chris and I will tag team. And the first thing I'd say is we really want to balance the different business lines to drive an optimized return on equity. We clearly are in a unique spot now on the origination platform where we're not just selling our technology capabilities and originations based on loans that are in our credit box, but now outside our credit box for the first time. And that's a whole new frontier for us. And so the opportunity set there really is open-ended because it's capital light, and capital light businesses, as you mentioned, drive better ROE. That said, we want to make sure we serve our members well and don't just focus on the absolute the percentage of ROE, but the absolute dollars as well. And having balance sheeted some of our loans for sale at a later point in time and generating the NIM is also contributing to our profitability and visibility both. So it's a balancing act on both. I'll turn it to Chris to talk about the specific funding mix.
Yeah, in terms of the specific funding mix, what I would say is it relates to deposits. Right now, we're about 85 to 90% deposit funded. That's our long-term target. So you could expect deposits to grow roughly in line with loan growth on the balance sheet. The one thing I would add, and we continue to have ample warehouse capacity as well. The one thing I would add to what Anthony was saying is we have opened up a new frontier by originating on behalf of others outside of our credit box. In an ideal world and going forward, the plan is to expand even beyond that and include other asset types like our student loan refinancing and school loans, mortgages, et cetera. So there's ample opportunity, a ton of headroom, and we won't be constrained by the overall growth in deposits.
Next question comes from Kyle Peterson from Needham & Co. Kyle, your line is open. Please go ahead.
Great. Good morning, guys. Nice results. Wanted to ask about in the loan platform business, really impressive results this quarter. Great to hear about some of the near prime ramp here. Wanted to think about, could we see another leg up in 3Q as some of this near prime stuff continues to ramp, or was 2Q kind of a pretty good run rate that we should use moving forward? Just want to get a sense of your appetite as to what the growth opportunity is here versus what the implied second quarter run rate is.
Sure, I can take that. So overall momentum's really strong. We just did $2.4 billion of originations on behalf of others. That was up from 1.6 last quarter. We did expand outside of our credit box. What I would say is we aren't guiding specifically to LPB originations in the back half of this year, but we do expect continued growth in momentum in both Q3 and Q4.
The next question is from Moshe Orenbuch from TD Securities. Moshe, your line is open. Please go ahead.
Great, thanks. Maybe to kind of follow up on the loan platform business, could you just talk a little bit about the scope of kind of the partner agreements that you've got? Like how much capacity is there? How long do they last? That type of thing. And maybe just to add on the comment about loan tokenization, is that to use as a funding vehicle, or is that a loan sale vehicle, or both? Thanks.
Yeah, the first thing I'd say is that the demand for the loan platform business is pretty broad-based and deep. Asset managers have capital that's coming in every day that they need to deploy against adequate ROE. We are very unique in our origination capabilities across the credit spectrum, but also we have great history and reliability in our underwriting capabilities from a technology standpoint, our marketing servicing capabilities, and our servicing. And so those with assets can more easily access originations through our platform than their own or others. And it's also going to be a steady stream of volume given how well capitalized we are and that we have a bank license. Those things really matter. Some of the other fintech lenders that can participate in these sales and forward flows, they don't have deposit funding. They're not a bank. They have different regulatory regimes covering them. We have the most stringent regulatory regimes and the most visible and stable funding, which factors into this as well, especially when you think about other things like fair lending and disparate treatment. The other thing I'd say about the loan platform business is that, we are not going to be able to serve everyone, and we want to pick partners that are focused on the long term, not the near term. So we're trying not to do, deals that could be a flash in the pan, gone, here one day and gone the next. We want durability in our relationships. We've learned that well over the last 8 years from our technology platform business that this is very similar to. We want to, make an investment in the long-term players that really see the value of our originations and our technology platform more broadly.
Yeah, and just to follow on to that, the only thing I would add, just to remind folks of the LPB agreements that we have in place and that we've announced. So we had an initial $2 billion deal with Fortress that started in Q3 2024, and then that deal extended for another $2 billion over the next year, starting in Q3 of 2025. We also announced a $5 billion deal with Blue Owl, which was a 2-year deal starting in Q1 of 2025. And then we also announced a combination deal with Fortress and Edge Focus that's $1.2 billion over 2 years, which started to scale in Q1 of this year. What's important to note, as Anthony alluded to, is that we have other partnerships with impressive firms, including investment banks and other investment managers that are also representing meaningful value for us today.
The next question comes from Peter Christiansen from Citigroup. Peter, your line is open. Please go ahead.
Good morning. Thanks for the question. Great results here. Anthony, I was wondering if you could just talk about discretionary spend. You know, you're clearly punching above the incremental margin target for this year. How do you think about spending for the remainder of the year on a discretionary basis? Is it towards things like member acquisition, or is it accelerating certain product development? And then as the loan platform business actually becomes a larger piece of the overall business, do you think SoFi still maintains that 30% incremental margin kind of target?
So I think you're starting to recognize we clearly have a lot of operating leverage in the model, and our margins could be well in excess of 30% on the EBITDA line. I've been a student of the evolution of direct-to-consumer technology companies starting back in 1999. And I think it's really critical that we invest for the future. We want to compound 25% revenue growth for decades, not just for a couple of years. So we don't want to underinvest in the business. You know, in the quarter, if we start to outperform relative to expectations on the revenue line, we're going to have a hard time spending that money back in the quarter. And so if you see us above the 30% incremental EBITDA margin in a quarter, it's because we outperformed relative to what we thought and we couldn't spend the money fast enough. But we're going to make sure that we keep putting 70 cents of every incremental revenue dollar back into the business. In terms of where we're spending it, the greatest increase in spending the back half of the year is in our engineering, product, and design areas. Specifically, we're investing in some new products that complement the SoFi Money product. We're investing in level 1 options as it relates to the Invest business. We're investing more and hiring more people in the user experience and Invest. Our Invest business is starting to gain really nice traction and momentum as we continue to see greater awareness of the broad selection we have. We're really unique. We're the only digital provider that's providing individual stocks without commissions, fractional shares, which I'd note we pioneered, our own SoFi ETFs, one of which is award-winning and outperforming its peer class quite significantly, symbol Sierra Foxtrot Yankee. We also offer IPOs. We're currently offering the Figma IPO. We also have robo accounts that have been award-winning, and we've introduced private investing through our partnership with Templum. We had an offering with SpaceX recently, as well as a couple of others and more to come. And then alternative assets were launched a year ago. And within alternative assets, we're providing opportunities to invest in venture capital funds, venture fund of funds, private credit, private real estate, public long short hedge funds, in addition to private growth equity. So the Invest business is getting incremental investment as well. In addition to that, we're hiring significantly in crypto to relaunch buy, sell, and hold by the end of the year. We'd like to also introduce a stable coin. We're really happy that the Genius Act was passed into a bill. It's going to take about 12 months to 18 months for all the different regulatory bodies to come out with rulemaking as it relates to the Genius Act. So all those potential competitors in stablecoin, they won't be able to really apply and get a license approved by the OCC until the back end of that time period. Because we're already a bank, and because the OCC put out an interpretive letter that allows and it's permissible for stablecoins at banks to be launched, we can launch sooner than other people. We want to be very thoughtful about how we launch that product and how it's differentiated in the marketplace. So we're not going to rush to get there, but we definitely have a head start because we already have the bank license. So we've allocated a lot of capital to crypto. In addition to that, we're spending a lot incrementally on AI. It's a great efficiency driver. We're right now investing in things like account takeover and and getting resolution of those in a very short period of time, as well as dispute resolution. We mentioned Cash Coach on the call. In addition to that, we're using AI to file suspicious activity reports. So it's a significant amount of incremental investment. It's going to drive growth in years to come, not in quarters to come. But in the near term, we're able to also invest in marketing to keep the really strong member growth that's driving product growth that then is driving revenue growth.
The next question comes from Kyle Joseph from Stephens. Kyle, your line is open. Please go ahead.
Hey, good morning, guys. Thanks for taking my questions. Just want to taking a look at the lending segment, and I know it's hard to do in isolation these days, but you had strong growth in ANR, and then the contribution margin profit have been fairly stable. Obviously there's some things in that business that you can't control, like interest rates, but with the success of the home equity product you guys talked about and some of the student lending or some of the changes on the student lending side of the business, just how are you thinking about kind of growth opportunities and profit margins in that segment?
Yeah, I'd say the margins in that segment in the lending segment will stay fairly consistent. It's a business that we have great visibility on. It's a business we own the technology sort of end to end with some partner, additional overlays in there. So we feel great about the business. Our home equity business we didn't have a year ago. It's obviously benefiting from rates being high, and that is really closing down the mortgage refinancing market and making the purchase market more difficult. So people are taking out home equity loans to do remodels instead of purchases. We've never been in a position that we're in right now as it relates to home loans more broadly. What do I mean by that? We have a team that's fully staffed. We have an end-to-end operation that we can control from the front end to the back end, and we are ready and poised and able to capture the opportunity when rates come down. I couldn't be more excited about what will happen in the home loan business as rates come down, given the capacity we have and the technology advances we have and the leadership of our team there. So they're doing quite well in this high rate environment. It will only be magnitudes better when rates come down. And then as it relates to the student loan business, we are seeing a pickup in student loan refinancing. It feels like a light has gone on in the last month or so. We've seen a pickup in the amount of refinancing and the interest in the product overall. I'd like to remind everybody that was our first and biggest business. It's now smaller than our LPB business, which tells you our diversification strategy moving towards fee-based revenue, capital light revenue is really working, but it's still going to contribute, and we're excited about what we're seeing and the underlying trends there for the first time in a while.
Our final question today comes from Reggie Smith at JP Morgan. Reggie, your line is open. Please go ahead.
Good morning. Thank you. Lots to talk about here, but I was curious. You mentioned all the investment in your invest segment. Where are you guys on your monetization journey for that product? I know you attract different users than Robinhood, but I was curious what the unit economics look like there today and kind of longer term. And then I guess more broadly, and I don't expect you to give me the actual KPI figures, but how do you guys manage or look at that business from a KPI perspective? I'm not sure if assets under management is an important factor, engagement. Like, what are the KPIs you look at internally to assess that business? Thank you.
Thank you, Reggie. We're excited about the invest business. The monetization is slowly starting to improve. As we get more assets, we drive more monetization through a number of back-end revenue streams. As we do IPOs and we get greater AUM into products like our robo product, as well as the private alternative asset investments and private companies, they all have revenue generation that are integrated into the product experience. Obviously, we don't charge commissions on single stocks or fractional shares, and some of our ETFs are also without fees. But we are seeing a nice pickup in a monetization there. We are profitable on a variable profit basis in the lending business, but the variable profit dollars is not greater than the fixed cost, so we're not contribution profit positive yet, but we'll get there in the very short order. Our goal there is to continue to give the best selection, the best service, and the best information, and we'll continue to roll out new products. Level 1 options will be a revenue contributor because it's a really well monetized product. In addition to that, we haven't really focused on margin lending. It's a secured form of lending. Our rate there is sort of off market. We need to bring it down and make it more attractive, which we have plans to do. This product also benefits significantly from members coming into SoFi someplace else and then cross-buying into Invest. But we're going to spend even more marketing dollars on acquiring Invest first members as opposed to just cross-bought members. So there's a lot of upside in the business. We don't talk about international that frequently, but we do have an Invest business in Hong Kong, and they just received approval for cryptocurrency offering in Hong Kong. So we're excited about that opportunity as well. So we'll continue to invest in acquisition organically and driving the cross-buy in addition to improved monetization in that product and that service. Then let's add on top of that cryptocurrency, which is a great monetization vehicle as well. And so you could see our monetization start to approach industry standards. We're about 50% of the benchmark, but all the things I just mentioned will improve the monetization quite meaningfully and get us to where everyone else is. In terms of the metrics we focus on total number of products within Invest. We look at the different mix of products within Invest. What of the members in Invest that are first to SoFi versus cross-bought? We obviously look at AUM and net flows, and all those metrics have been really positive.
At this time, I'd like to turn the call back.
Great.
To Anthony
With
Neto for
that,
closing remarks.
Thank you, operator. And thank you all for joining today. I'm going to spend probably 2 to 3 minutes on a closing, a little bit longer than we normally have done. We're really excited about something that we rolled out at our company recently as we think about trying to become the best culture in the world. I've talked about publicly since I got here nearly 8 years ago that we want to have the best culture in the world. And that may sound like hyperbole, but it's not when you really think about the critical success factors to having the best culture in the world. It really comes down to leadership, alignment, and accountability. It doesn't require capital. It doesn't require IP. It doesn't require big capabilities or licenses. It requires leadership, alignment, and accountability. And we are sticking to that goal, regardless of how audacious it may sound, because we think those 3 things we can control and do them better than anyone else. I could not be more excited about our future or more proud of our team. And I'm really excited about rolling out publicly the SoFi Way, which will be available in social media after the call. But let me spend a few minutes talking about it. Over the last 8 years, we have always charted our own course, not just a technology company, not just a bank, but a team that stayed true to our mission, our members, our strategy, and our core values, despite the changes in what's most popular for the day. Redefining an entire industry wasn't bound to be easy work, and it's not for the faint of heart. It takes a certain group of people with diverse perspectives and expertise, but with a common sense of purpose, willing to challenge assumptions, but to always do the right thing, proving that innovation and responsibility don't have to compete, but can combine to create something truly unconventional in the world. That's the SoFi Way. And now more than ever, we're doubling down on our culture and on the behaviors that make SoFi what it is, so we can serve our members and clients better than ever before. First, we must all act as founders. Great companies are often born from great founders with a bold vision and tenacity for making it succeed. But when everyone in the organization has the same mentality as the person who started it, that's a secret weapon. At SoFi, we all act as founders of the business, acting with urgency, doing the right thing, always taking ownership, making our footprint bigger than our foot. We all act as problem solvers. It doesn't take too long to realize that running after problems is in SoFi's DNA. That's because we're doing something that's never been done before. So we iterate, learn, and innovate to fix what's broken for our members, clients, and colleagues. We want to understand how things work, to get to the truth with all the right data and perspectives, and to iterate, learn, and improve on everything we do. We take pride in being gritty, liking hard challenges, setting ambitious goals, and taking accountability for results. And we all act as partners. It all starts with our members and clients. We obsess over their needs and helping them realize their ambitions. We seek to win on their behalf, together as missionaries for SoFi. It's why we take care of each other, especially those on the front line who are closest to those we serve. We embrace our differences and help each other grow, and we never forget to smile. Thank you for your interest in SoFi. Thank you for your support. Fresh horses we ride.
Goodbye.
I'm not going to be a Debbie Downer, but the SoFi way seems a little disappointing to me. I thought there was going to be like something really cool, but it sounds like it's just a mindset.
You can tell he definitely has that military background, right? He's like, everybody on the front lines, we're missionaries for SoFi. We take care of each other, and like you can tell that that's like his entire like mentality.
Yeah, yeah. Overall, I think they're going to kill it. I mean, I really do think that he has the potential to be one of the largest names in financial services in general, especially in the United States. But you know, they showed interest to do this in international markets as well. And I think that that would be an amazing legacy for him to leave behind. And wow, do I think he's going to go after that in the next 10 years for sure. And the fact that I get to sort of, you know, put money behind him and bet on his success is such an insane opportunity that we as investors have. I mean, I get to sit here in my office and just talk crap, and yet I'm going to benefit off of his actual hard work. What were your guys' initial thoughts of the call?
Really, really positive. Like, I mean, they just underscored everything that we saw in the numbers. There were a couple things that were interesting. The tokenized loans to like small dollar amounts. I wonder if you eventually, like in SoFi Invest, if you'll be able to buy SoFi LPV volume. Like,
that's what it sounded like.
That's what it sounded like to me, right?
Yeah.
Which is super cool. It's just like, it's innovative, it's creative, it's interesting. It's something that they are uniquely positioned to do. He also said in one of the Q&A sections, in the Q&A session, on one of the questions, he actually said that they wanted to compound it at above 25% for decades. They'd only ever said 20%. Maybe that was a slip of the tongue. But like, I don't know.
Sorry, say that again.
They said that he said in the past quite a few times, they want to compound their business by 20% for decades, not for, you know, years or quarters. He said in the answer to one of the questions, he said they want to compound above 25% for decades, which would be crazy. Like, that is ridiculous.
In the sentence before, he was talking about an overall growth of 20 to 30%. So he probably just took the midpoint.
Yeah, I think maybe he said it wrong. But even still, like, I feel like this is the first quarter where you can really see the entire ecosystem doing what they set out for it to do when he joined the company in 2018. Like, you can see the flywheel going. You can see how how all of the different segments are feeding into each other. How they also gave a couple of metrics. I didn't write them down, but on the when they talked about the Banco Nacional deal for Argentina, they gave a couple of metrics about like the speed to market and the ability to like start accounts. And I can't remember. I'll have to look at the transcript later, right?
Yeah.
But it was nice to see those actual metrics so that then they can show those off to others and be like, hey, we can decrease the amount of time that it takes you to start a new account by X amount.
I was live posting a lot of the call because I was transcribing it on the side. So I have a couple of like the direct quotes on there. But yeah,
give us some of the best. I'd love to.
Yeah, go ahead.
Hear it. I couldn't end up opening up my Notion, so I was pissed about that. Taking documents in Google Docs made me I was furious.
Yeah. So this is the return on investment that Chris was talking about. He said we don't want to underinvest in the business. If we start to outperform relative to expectations on the top line, we're going to have a hard time spending that money back in the quarter. So if you see us above 30% incremental EBITDA margin in quarter, it's because we outperformed to what we thought and we couldn't spend the money fast enough. But we're going to make sure that we're putting it back at 70 cents of every dollar. In terms of where we're spending it, he mentioned that they're doing level 1 options for Invest business, more hiring and people in the user experience in Invest, and that the Invest business is gaining nice traction and momentum. So basically saying like, you know, if we have high EBITDA margins, it means that we couldn't find ways that we could have high ROI on that money, but just generally don't expect like over 30% because we want to reinvest that back.
But every single quarter they say that, but every quarter they outperform because every quarter their incremental margins are above 30%.
Yeah, well, he also said, hold on, I have the quote here. He said, I think our biggest challenge beyond 2025, quite frankly, is deciding what not to do. There are more opportunities on the table for us than ever before. It feels like we're just getting started. And we've been at this for 8 years, and it's delivered good, consistent growth. Our goal and prioritization will be to allocate those resources to those segments and those businesses that can drive the best compounded growth over decades, as opposed to just a couple of years with the overall growth, with the overall goal of ROE that's 20 to 30%. And it was interesting because he mentioned a like a decade-long viewpoint multiple times in the call. And multiple times in the call throughout the Q&A, the opening remarks, and even the closing remarks, he was saying, like, we don't want to just optimize for the next couple of years. Like, we want to optimize for the next decade.
Which, if you think about it, so I got to be careful what I say here, but investors that have a long-term mindset, that have long time horizons, meaning you don't need this money.
Mm-hmm.
If you are looking to buy companies, I've always liked to purchase the companies that are focused on the multi-decade things or multi-decade outlooks, because a company like Amazon, for example, continues to reinvest back in the business to stay on top. And you're not looking, at least for me, this is what's worked out for me, companies that focus on dividends and maximizing shareholder value actually end up losing market share because they're not staying on top of the products that actually make customers come back. So for my strategy, I like to invest in companies that continue to make sure that their customers are the things that are, the sticking point. What's the Jeff Bezos quote? There's never been a misalignment between customer value and shareholder value. What's the, Chris, you probably know it.
I don't know it off the top of my head, but I know which one you're talking about.
Yeah, essentially saying that, if SoFi continues to focus on their product and not the dividends or buybacks or something like this, that we'll actually get that in spades in actual shareholder value. So this is a potentially even cheap price on the company. I mean, very, very cheap if you're considering that they are going to be growing at a 25% clip for the next decade. Like, very cheap. And a long runway for this business if that's what Noto is planning on doing with it.
In the long term, there is never any misalignment between customer interests and shareholder interests.
There you go.
In the long term.
Yep.
In the short term, happens all the time.
Yeah, it does.
Of course, you could buy this company for $4 a couple quarters ago, and that was not like, we understood what they were doing back then as well. People just got lost in the sauce.
Yeah.
But it happens. And that creates a lot of alpha.
Dude, was it just me that felt like this time around the analyst questions were so incredibly...
They were terrible.
Level, like, so bad.
They were awful.
What do you plan on doing with SoFi Invest? Can we move on?
Yeah, like, I know you provided guidance. Can you provide segment guidance? And the next question, I know you provided segment guidance, but can you provide a little bit more color? Like, are you guys fucking stupid?
Are you updating your 2026 guidance? No, if they were updating their 2026 guidance, they would have said, we're updating our 2026 guidance. Like, and even, I love Dan Dola, but his question about, hey, what's going on with Chime? Nobody cares about Chime. Nobody cares about the accounts that are like churning. Like, talk about SoFi's business, right? Like, yes, we know that Chime's debit cards are going to go off and that some like accounts are going to drop. Who cares? Nobody cares. Like, there's way better things you could be asking about.
And like, that's also one of those questions, like, Lapointe is not going to answer that.
Right, exactly. It's a throwaway.
Yeah.
Anyway, it's fine. We love Dan Dola.
Yeah. Did Devin Ryan didn't ask a question, eh?
I don't think I heard one.
No, I didn't either.
They have to save the room for Reggie, man. There's no room for Devin Ryan here. There's like, Reggie comes first and then everybody else after. I'm glad he actually got to ask a question this time around, because last quarter he did it.
I'm so excited for the reports that end up coming out later, even from the most bearish analysts. I can't wait to see what they have to say.
Yeah, I can't.
Yeah.
What could they say? Like, how could you be bearish after that quarter?
You know what it's going to be? It's going to be about the TAM for lending. Is that SoFi can't continue this growth because personal loan volume is not big enough for them to continue to expand at this rate.
But it doesn't matter.
Yeah, like Anthony Noto says, it's actually the credit card market that we're going after. It's not the personal loan origination market that we're going after. So they can continue to keep up this growth for a long time. I am going to reach out to SoFi again and ask if we can be on the call next time. They're going to say no, but come on, guys.
I just tweeted at Anthony Noto and the IR, and I was like, guys, like, if you want to step up your actual Q&A game, like, just add like a couple of retail questions, because this was just pathetic. Like, the quality of analyst questions was horrible.
It was so bad.
Also, did you guys see outstanding diluted share count?
No.
It went down.
How's that possible?
I don't know. It went down 3,000 shares, quarter over quarter.
That's weird. We'll have to chase that down at some point.
But I didn't find anything in terms of repurchase or buyback or anything like this. So, I was a little confused by that.
It might be, this is just spitballing, it might be the 2026 convertibles. They might have a different amount.
That is what it is,
because
for sure.
If the share price is actually higher than the because they have the capped calls, then they might be assuming a lower dilution from those numbers.
That makes a lot of sense because it's fully diluted. So if they make any change to their options or anything like that, that would just lower it.
Yeah. Mm-hmm. So
you're right.
When do Noto and LaPointe get their $25 tranche with PSUs?
How long does it have to hold it? It's 30 days or 90 days?
90 days. 90-day VWAP.
Yeah.
So 90 days from now?
Maybe.
Well, it's 25 is the lowest rung.
Yeah. I think they easily get it before the end of this year.
Yeah.
25, 35, 45.
Because it's September or October. So let's mid-September.
Right, because it's the average. Because it can dip below 25, but as long as the average is above 25.
Yeah, for 90 days.
Yeah, it can dip below, but the higher days will help pay for the lower days. It doesn't have to stay above, like you said, weighted average.
Yeah. Dang.
So, but dude, honestly, and this is something that I need to continue to learn from Amit, is like, if you have a winner, just double down on your winners. Like he's been buying a ton of shares of Robinhood at 100 plus, and it's like
70 and 100, and
do I really think that the top for SoFi is $23? No. Like, if they pull out another quarter like this next quarter, what's the stock going to do? What's going to happen over the next couple of weeks if analyst upgrades start to pour in? What's going to happen whenever short positions realize that this is not a flash in the pan? This is a straight up compounder. They're going to have to leave. You think we're having 12% short interest after this quarter? I doubt it. There's not a thing they'll be able to point to.
Yeah, and keep in mind, rates haven't even come down yet.
Yeah.
Even the one thing that I pointed out that I didn't like, the student loan defaults rising, Chris LaPointe said that in the call, and he was like, yeah, this is actually because of a book that we purchased. If we didn't have it, we wouldn't have gone up at all. Insane. Rate cuts are coming in, right? We now have the SoFi way, so that's another $5-10 there, something like that.
That means that Noto's going to tweet about the SoFi way all the time. That's going to be the new fresh horses we ride, or who
I honestly think that's what that means.
I
was hoping for some sort of either co-owned or something like where they were offering more stock-based comp or something to make shareholders feel like founders. But just telling someone that you have to feel like a founder, I don't know how that makes them.
And especially that company, it's like, really? Do you want to feel like those founders? Because
it's going into founder mode. It's not being that founder. It's founder mode.
Yeah, and I mean, to be fair, Anthony's not even a founder, but being a quasi-founder of SoFi, he definitely feels like the founder of SoFi.
Yeah, I consider him. He refounded the company when he came on in 2018.
Yeah,
because it's a completely different business, like altogether from where it was. I did so I tweeted. I don't know. I think it might have been anyway last week. I think I said that like most of SoFi's growth has been fairly linear up until this point, right? I said it's time that they really need to start moving towards like an exponential growth. I feel like this is the first quarter where we really see that, and that's going to continue. Like I think that these are going to start looking more like exponential curves than they are like linear curves from here.
Yes, I completely agree. And also all the rungs of the business that have sort of stayed stagnant before, home loans, student loans, even to some degree, credit cards, definitely. The credit card default rate this quarter, I think, averaged at around on an annualized basis of about 7.7%. That is now in the margin of normal banks. Like whenever it was up near 20%, and I was banging on the table saying, "Hey, we need to be between 2 and 8%. Like this is unacceptable." Now it is within that range and potentially could still continue to fall. Hopefully.
Yeah.
So, it's now at an acceptable range. That's why they're doubling the amount of credit cards that they end up putting out. The interchange revenue is going to skyrocket. Like Chris said, that leads to customers like I know one of the big things was that SoFi doesn't show off monthly active users. You want to look at monthly active users, focus on interchange fees. Like that's a pretty easy way of seeing how much people are using this product on a day-to-day basis. And credit cards are a great way to bring up those fees and increase the total revenue per customer. I don't see a single thing wrong with this quarter so far, which is strange.
I have to bounce. I can't be here for the opening bell, but great quarter. One of the best we've ever seen, probably the best we've ever seen. A lot of analyst upgrades going to be following shortly. Anthony Noto is going to be doing the rounds on CNBC and Bloomberg and all the others. And probably we're going to get some type of press release later today, at least post thread around the SoFi way. Love you all. Gotta go. Bye.
See you later, brother. I'm even going through their expenses and stuff. Like technology development costs as a percentage of their revenue is going down. General and administrative is going down. Cost of operations is sort of staying flat, if not going down as well. But sales and marketing staying exactly the same. Really? 31% of revenue. And I think that's what we're going to see going for. I promise you. Well, I don't promise you anything. I have a strong feeling that's not going to change at all. Like, if they want to keep up this 34% year-over-year growth rates on members, if they're going to try to hit 50 million members, they have to keep sales and marketing exactly where it is.
It's true. And it's worth it. That's the thing, is that the lifetime value of those customers is increasing now even faster as they've got a better ecosystem.
Yes, which means they can actually ramp it. And yes, customer acquisition cost did increase like I expected, went from 300 to 319. But that's how we're going to fund the loan platform business and have the highest amount of originations and these are not bad statistics at all. This just is what has to happen. The fact that their customer acquisition cost is so linear and they know exactly how much they can pay for a certain outcome is an amazing place to be.
And you'd expect that number to come up as you get new, you're going to pay way more for an LPB client than you are for a low or for a money or a relay client. So it doesn't concern me in the slightest. A lot more. Yeah. You pay, what is the average loan? It's like 30 grand and you get 5% of that, right? So immediately out the door, you're looking at something like, if you pay $1,000 for that member, you make $500 in 10 days, right? You make and we know that their contribution margins are actually higher than that. And they're going to be, it's amazing. But it's totally worth it.
That is Upstart's business, right? Is doing that. Now tack on the fact that we have a 1.46, whatever it is, products per member. We're paying for that. We're getting the immediate turnaround on, the gain on sale margin through loan platform business. And now we're cross-selling them credit cards, debit cards, everything like this. Like, that's the exciting part. I mean, holy.
Yeah.
I don't know why this all went gray. I don't know what's going on, but also,
What
if
a
I could just
quarter,
give a
man.
quick little shout out. NVIDIA is 178.84. We were actually at 179 earlier. I was hoping we were going to hit 180 today. That would be freaking insane. Novo Nordisk down 21% in pre-market. UNH down 5.4%. That continues to be the falling knife that is hard to catch. PayPal down 6%, guys. Holy crap.
Ouch.
Oh, man. PayPal's one of those names where it's like everything that they're doing, every press release, I absolutely love. Pay with crypto, PayPal world. I cannot get enough of what Alex Chris is doing there. But there's something on the actual financials that just keeps continuing to not allow investors to see a turnaround here.
Yeah, I don't know what it is either, because they also beat despite the Braintree headwind, right? Like, we knew about the Braintree headwind going in. They had what I think you said it was 7% revenue growth year over year, even with that headwind, which is actually pretty darn impressive.
Yeah, something like that. I'm going through the report right now, which hold on one sec. Let's just see what Andrew says. Tanner, I've been watching for roughly 3 years. Over that time, my wife and I have accumulated roughly around 10,000 shares at $7. Thank you all for what you do. Andrew, thank you so much. I do appreciate it. 10,000 shares at $7. That is a nice place to be here as we potentially open up the day at 23. It's a quick little triple for you. So that's absolutely amazing.
Man. Like, I was excited for this quarter. Like, I thought it was going to be good. This beat all of my expectations.
This is better than anything I would have expected.
Yeah.
I mean, obviously, because we literally did predictions, which, by the way, I honestly, even though we missed, I still think we're getting so great at understanding their business. They just, if they add on so many new members, then all the numbers on lending and financial services just get, hyper extended. So
and the one thing I did say, like, is I was like, the LPB is the one thing that I'm still not sure of, because they're still in this infancy phase where they could be adding student loans, where they could be adding home loans, where they could be expanding the credit box. And then what happens? They expanded the credit box, right? And all of a sudden the volume just jumped.
Yeah. As long as they can keep because I think that's an important part that people need to understand as well, is like, just because you can underwrite in one credit box doesn't mean that you're an expert in all. So if SoFi can continue to kill it in multiple credit boxes, we have a true winner here.
Yeah.
Which, I mean, clearly for a lot of investors, that's already the case. I mean, I don't know if there's many investors watching that have a share price or an average price over $23 a share. And if you did, I mean, where's the DCA? Like, I mean, you're just missing just straight easy investing strategies whenever the stock was at 764, Anyway.
Yeah, no, totally. The one thing, so I mean, I've been following Upstart for years now, right? Like, I started following and covering them in 2021. The one thing, so kind of as SoFi started the loan platform business, the thing that was interesting is, so it's possible that like Upstart's underwriting is better than SoFi's, but what it's turned out, what I think the truth of the matter is that it's more important to be able to have a low customer acquisition cost and get repeat than it is to have a better underwriting. Like, the underwriting is good enough, right? Like, if you have good enough underwriting, which I think Lending Club and Upstart and SoFi all actually have above average underwriting, like that they have above average returns on their investment. They have above average, defaults, I guess below average defaults. But the fact that SoFi has been able to scale the LPB so quickly, I think it's because they have this ecosystem effect where people return to them and where people go to them first. and that their return, even though their take rates are lower than upstarts, I think their returns, their contribution margins are actually higher than upstarts, which means that their customer acquisition cost is a lot lower. So I think the key is it's not necessarily that their underwriting is better. And I don't think that underwriting is actually the unlock to be able to really monetize that type of a business. I think the bigger unlock is having an ecosystem that allows you to have a lower overall cost, customer acquisition cost. Because if they get somebody into the LPB who joined on money, like
market just opened, by the way. SoFi now going to up 12%, 13%, 23. Are we about to break 24 right now? This is actual open market, real volumes here, pushing the stock even higher.
Oh my gosh.
I was actually expecting a large sell-off whenever the market opened because institutions have done that before. I put out a poll on X that said, are we going to pump or dump? It was a 50-50 split. We'll have to wait till close because there's going to be a lot of volume on these names. But PayPal opened down 7.6%, 8% now down. UNH down 7.5%. Novo Nordisk down 21%. SoFi up 13%. Oh my God, pushing higher here. Sorry to cut you off, but
no, you're good.
The market is open, ladies and gentlemen.
We don't have a bell to ring.
No bell. 24, ladies and gentlemen, up 15%.
Dang.
Look at the freaking volume here.
We might hit a SoFi all-time high. We're 40 cents off.
Oh my gosh, ladies and gentlemen. I heard it. I saw a couple people in chat whenever we saw these little dips. They said, I'm selling everything. I'm selling everything. You don't sell SoFi. That's the truth. Okay. Anthony Notos takes us higher, not on the day, not on the week, not on the quarter, but years to come. Long-term investing is about bidding on the companies that compound yearly over time and let the let the weighing machine tell you what the true value of these companies are worth. That's why we bought at 4, 5, 6, 7, 8, 9, etc.
Dang, dude.
And we push higher. And we push higher up 16, 16.5, 17%. Holy crap.
We're 2 cents away from an all-time high.
We hit 24.63.
Yeah, 24.65 is SoFi's all-time high.
And by the way, what he means is that there was
the SoFi ticker.
Yeah, there was IPOE and then there was SoFi. So during IPOE, it was higher than what it was whenever people actually found out that it was going to be SoFi, the actual ticker. We just hit it, 24.67, ladies and gentlemen. That is a new high for SoFi's ticker. And we're at a $27 billion market cap. Can you imagine if we get into the S&P 500 before Hood? We need to keep this price for a little bit.
I don't think that's going to happen, but it would be awesome.
They haven't selected them yet. You know, they're putting in Block over Robinhood. They're not picking IBKR. They're not picking Hood. Maybe they don't want a brokerage.
We might break 25 today. We're so close.
24.85. We hit 24.94. 24.97.
24.98.
Ladies and gentlemen, if we have 25, I mean, we got to have a freaking party here. Holy
crap.
Either way, if it does not close above these levels, this was still a smashing quarter. And yeah, just wow. The compounding machine continues on. The great thing that I actually do think long-term about higher share prices is it allows for better talent, right? New employees that want to come on, see that this stock is working. Stock-based compensation goes a lot further. That is the benefit of having a stock that runs this much. But ladies and gentlemen,
it hit 25.
We hit 25.11.
It hit 25.
$25.11. That is insane. My only mistake was not picking it for the stock draft, or else I would be not in first place above Matt. But
yeah, you could have had it in like round 3 or 4, man.
Yeah, round 3. If I would have switched it out for service now, that would have been the ultimate play.
Anyway, it's fine.
We live and learn. I didn't think he was going to pick it. I wanted it in the draft 100%. I just wanted to pick out some names that I thought were going to be more up Matt and Chris's alley than what we saw.
It was a strategic decision that came back to bite you.
Yeah, it was strategic, but it was just dumb. We could be strategic and dumb at the same time.
Dang.
It did hit 25.11. According that is true. TradingView is correct. If you take a look on my screen right here, 52-week high, that was what we just hit there. So that was right at the very tippy top. We hit 25.11. Wow.
Dang. The all-time high from IPOE days is 28.26.
28.26. That's the next one to hit.
Yep.
And what would that bring us to? Nearly a $30 billion market cap?
At this point, I think it would be above 30. No, it'd be way above. We're at $27 billion market cap right now.
Remember what happens, right? Every single quarter that we end up showing off that has higher net income than the year-over-year comparison increases our trailing 12-month earnings. This lowers the price-to-earnings ratio, allows investors and algos to potentially bring it back up to where it was before, assuming that the growth rates stay high and that the long-term aspirations of the company stay high. But that's exactly what we saw. We saw an increase in guidance, a sticky amount of 55 to 80 cents for 2026. Wall Street analysts aren't even at 55 yet. They're at 50 cents. So this is only going to improve not only this year's earnings. If it doesn't improve 2026, then we have even a further way to go from what analysts have to say. Holy, what an open.
48 million shares traded already.
Hopefully they're doing it on SoFi Invest.
I don't care where they're doing it as long as they're hitting the buy button.
Yeah. Congratulations, ladies and gentlemen. This is freaking exciting. Oh my. PayPal down 9%. Novo Nordisk down 20%. NVIDIA up 1%. Yeah. I mean, freaking SoFi made me more money than NVIDIA made me today, which is pretty rare for me.
SoFi's my biggest position, so we're doing quite well today.
You're the real winner here. Up 17%. Oh my. That's got to feel unbelievable for you.
Yeah, it's been a long journey, man. We took a lot of crap along the way.
We sure did. And it's not going to be over. I mean, there's going to be constant bears, but that's investing, right? There's a market. There's a buyer and a seller for every position. I'm a net buyer of SoFi shares. Haven't sold a share since I've held it. Wow. Good luck to the people who wrote covered calls through these earnings. I don't think many people would have expected a 16+% move in the stock whenever it opened today.
Yeah. I didn't expect this.
No.
I also didn't expect these results.
Man.
That's the best part about it. The best part about it is that it's justified. Like, the entire move up seems completely justified. That's what, like, it's not overvalued. It's not like trading at nosebleed valuations. I mean, on a price to shares or price to sales basis, it's still below Upstart today after this move.
I love how at the beginning of the day or on X, I said, hey, are we going to do a pump or a dump? And, you know, the difference of the pump and dump, like whether some people were saying, oh, you know, it might end up 3% up or something like this, like 17%. How many people actually thought this?
What's the best ever daily move on SoFi? It was back in like the crazy days in 2021.
Yeah, we've had some crazy days. We've had some crazy days. It is justified. It really is. And that's the interesting part, is that if you're a long-term shareholder, this is a price worth paying, you know, because you potentially believe in the fact that they're going to have 900,000 new members next quarter or 1 million the next quarter after that. And if they can continue to keep up that sales and marketing cost that brings in new members that they can cross-sell into the loan platform business, financial services, continue to close deals on the tech platform, push out new level 1 options in crypto, all through the SoFi way, then, we're headed higher. That's investing.
So the 2 biggest days were actually like back in 2022, and then they eventually sold off like really quickly. But in May of 2022, there was a 19% day. And in August of 2022, there was a 28% day.
28%.
But it went from like that 28% was earnings. It was actually Q2 earnings of 2022. It closed the day before at 641, and then the next day it closed at 823.
Yeah.
So, but this will be, I think, again, if this holds up, which it might sell off from here, it would be the biggest absolute jump, I think, ever.
Yeah, in terms of market cap.
In terms of, in terms of dollars.
Yeah.
We've never had a $3.50 move, I don't think, on the stock, except for IPOE days. There's like one day back in IPOE days that was just like ridiculous. But I don't count those.
One thing about investing, right, is that like, and this will happen at greater lengths before, is that I forget what the lowest price that I bought this stock at. I think it was like 468, something like that. I forget what the exact number was, but it was in the 4s. That there will come days that we have larger moves than what the stock was at previously.
Right.
You've seen Palantir do this. You've seen Robinhood do this. It happens just in the form of compounding. I mean, you either keep your money in cash and you lose to inflation and other things that are tearing down the dollar, or you put it into, revenue producing assets that actually generate you real income and in the form of potential dividends into the future. Now, that doesn't mean go on Say Technologies and say when dividend, but there will be dividends from SoFi into the future. They will return money back to shareholders. Every company does eventually, Amazon, maybe not. They're trying to push it, but
Amazon doesn't even do buybacks yet, do they?
Yeah, they do.
Oh, they do? Okay.
Yeah. Not a lot. But
it's small though, right? Relative to,
like, I think for the size of the business, I think they've done like $5 billion quarters, but it's nothing compared to the multi-trillion-dollar business that they really are.
Yeah, it's like less than, it's like 0.2%.
And it's not consistent the way that like Google or Nvidia's are.
Right.
It's more selective of whenever the stock is oversold. But wow. Do you want to wrap it there?
I think so. Yeah, I think I gotta do real work now, unfortunately. I don't know how much I'll be able to focus today.
Yeah. It'll be a lot of chart staring for a while today.
Yeah.
Getting used to the new prices. Ladies and gentlemen, thank you all so much for watching. Really do appreciate your time. This has been a lot of fun, and can't wait to do it again next quarter and the quarter after that. The SoFi train doesn't stop.
That's right.
Bye for now.
See ya.